The reality is this is an arms race.
We've come a long way very quickly.
It's healthy to see the market digest, the market to rotate a little bit.
We're still in an environment where you have earnings growth continuing to rise.
Is this an earnings bubble? The answer is no, it is not.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, tech stocks inching lower. Equity markets snapping a four-day rally, pulling back from all-time highs as investors brace for the beginning of the staggered end to the SpaceX lockup. And underwhelming earnings from SanDisk are sparking a flash crash in SK Hynix, dropping as much as 30%.
Yeah, and this just really goes to the ultimate question of how much has the leverage actually been beaten out of the system? How much has the volatility driven from South Korean stocks actually been taken out of the system? SanDisk missing earnings, Western Digital not exactly overwhelming earnings, and suddenly with 11 trades, the shares of SK Hynix can be down 30%. On an exchange that actually has had somewhat of an issue in terms of being able to accurate
Can you make the argument we've had a clearing event when you still see price action like that in the last 24 hours?
The fear is no, and that is why you're seeing a little bit of hiccups. You've also seen a bounce back that has gotten a lot of people really nervous, where people are saying, okay, we've already taken out the undersold or sort of oversold, and now we're overbought in a couple of days, and that's the reason why people are getting a little skeptical.
Let's talk about a bond market that might be making some people nervous as well. 2s, 10s and 30s this morning, yields higher by, let's call it a basis point. The 10-year at around 462, the 2-year at around 420, 517 on 30s getting people's attention, still around 520. The Treasury Secretary, Scott Bessent, with a few things to say about the journalistic community, incapable of performing real economic or monetary policy analysis without being spoon-fed.
Well, that's not actually also their job. This is a journalist who's going to report on what his sources are telling him, and he has every right to do that. A lot of people have a lot of reaction to this tweet, and they're going towards the fact and looking back at what did Nick write recently. And he wrote something recently about the facility that the Treasury used, that's part of the Federal Reserve, to intervene in the yen. And actually the fact that the Treasury Secretary wanted to expand that. An individual who's talked about mission creep at the Fed. Well, this kind of sounds like mission creep.
You're talking about Nick Timiraos, and that's who he singled out and actually named in his X post. And it really was interesting to me how different the rhetoric has gotten. And we were talking about this yesterday, about how there was this conflating between reaction function and forward guidance. And it's very difficult to have an argument about anything when there is this vitriol being targeted at specific individuals for overall not having done their jobs or being weak or whatever the case is. It is hard to have a sort of academic discussion about what is the appropriate path of action.
Most people we speak to are very happy to move on from forward guidance. Let's park that there. Any criticism to the Fed chair and its recent performance in its early days, and we should give him a chance, but any criticism so far centers on one thing: his refusal to articulate his reaction function and an apparent unease to draw a distinction between that and forward guidance. Getting the answers to the test and understanding the formulas to answer the questions are two very, very different things. And I want to move on from this debate because I keep hearing the same thing again and again and again. People are just unhappy about the end of forward guidance. No, they're not. I'm thrilled about it. Absolutely thrilled about it. I just want to understand where he stands on his reaction function, so that when you see the data, you've got a better idea, just a better idea of what it means for the Federal Reserve. That's very different to forward guidance.
We're getting reaction functions from the other Fed officials, and what we're hearing is that next week's CPI report is going to be crucial in terms of understanding just whether the inflation rate in this country is accelerating or whether it's decelerating enough to keep them on hold. Whether Kevin Warsh is on board with that still remains a question. We don't know exactly where he sees things going, what exactly he wants to lean into to restrain inflation, because increasingly the debate isn't just reaction function. It's also what's the best tool to bring down inflation, because it seems like maybe this is someone who might lean more on the long end than on the short end.
And making matters a little bit worse, the fact that the Treasury Secretary is coming out and going after journalists in defense of Kevin Warsh. The Wall Street Journal front page this morning is what? The President of the United States has been calling Fed Chair Kevin Warsh in bursts, according to sources. They maintain a line of communication. So we're trying to understand how Kevin Warsh is going to react to certain situations. Does the president know how he's going to react in certain situations?
I have absolutely no problem with criticism of the journalistic community whatsoever. No issue. It's the whole of Wall Street that are asking the same questions. It's policymakers in and around the Federal Reserve asking the same questions. It's not the journalist. And as for the Treasury Secretary, he's talked about going through a detox. It's the Treasury itself that seems uncomfortable with the detox right now, who are offering their own forward guidance about what's about to happen with Treasury issuance. It's the Treasury itself right now that seems uncomfortable with spillover risk coming out of Japan. What about the detox that we need to go through here in America for running persistent 6% deficits, even in the good times, that are weighing on Treasuries and pushing up yields? The Treasury itself seems very uncomfortable with the detox process this bond market needs to go through.
Yeah, and there's some speculation that they might actually reduce the amount of 30-year yields that 30-year bonds that they end up selling going forward, and increasing the bills that much more, which once again makes the Fed all the more political.
We can build on this throughout this morning. We'll catch up with Bob Elliott of Unlimited Funds as equity snap a 4-day winning streak. Gil Luria of D.A. Davidson as SK Hynix suffers another 30% flash crash. And Nela Richardson of ADP as wage growth complicates the Fed's policy path. We begin this hour with stocks hovering near all-time highs. Bob Elliott of Unlimited Funds writing the rotation isn't a sign of resilience but misplaced optimism. As talks ramp up, folks ramp up, the FOMO caution is warranted. Bob joins us now for more. Bob, good morning. Good to see you.
Good morning.
What are your thoughts on this rotation so far? And do you think we've had that so-called clearing event that's going to allow us to rally on a sustainable basis?
Well, it looked like even a week ago that we might be moving towards to the point where we got a clearing of the mania that existed in the AI and semi sector. And all of a sudden, we're back to FOMO and catch-up here. And that's really been the driver of what's been going on in this market, is everyone is so concerned about being behind the curve as prices go higher and higher. It's classic bubble-type activity. Now, calling the top in a bubble, a little challenging. Anyone who's been in this business for long enough knows. But when you see something like that, you've got to recognize that levering in and going full bore on the bubble is often an imprudent move.
You're calling it a bubble. Just define why you're calling it a bubble right now.
Well, I think a classic bubble is extremely high expectations, which, to be clear, on earnings, we have the highest expectations for earnings growth over the course of the next 5 years that we've had in the post-World War II era. An extraordinary outcome is priced into these markets, combined with the fact that people are using significant leverage to buy assets because they're already full up on getting exposure to these names. They have to go and add leverage, and that leverage is everywhere. I wrote a recent piece in my Substack called Leverage Everywhere. Right? And it's interesting, this isn't the leverage of the GFC concentrated in highly levered banks. This is like Wells Fargo giving significant amount of securities leverage to their wealth clients. This is levered ETFs. This is options trading. It's kind of everywhere and diffuse, so it's hard to point to the exact place where all the leverage is piling up, but it's kind of everywhere. And that's a good sign that this market is overbought on borrowed money.
So what would make you think that actually is starting to get cleared out? Because some people were saying that after the declines that we had seen in some of the chip names, as well as the hyperscalers, and then, of course, with situational awareness, that gave them the confidence to go back in. What are you watching that says, hold on a second, not so fast?
Well, I think one of the challenges is the rotation means that the overall S&P 500 earnings expectations actually haven't changed that much. Right? Overall, at the economy-wide level, hasn't changed that much. We're just sort of shuffling between whether the money goes to the AI names or the hyperscalers or to the real economy, let's say. And the challenge is when the overall expectations are so high at the economy-wide level, this shuffling can get confused, and you might think, oh, things have repriced. But in aggregate, we're still expecting over 20% earnings growth for 5 consecutive years. That's an extraordinary outcome that's priced in.
But the earnings have actually been extraordinary, and it's actually been some of the best earnings we've ever had outside of a recovery period post-crisis. Why do you think that is unsustainable, especially given where rates are here?
Well, you can have earnings for a quarter, you can have earnings for 2 quarters. A lot of that stuff is asset-oriented earnings, right? A big chunk of the earnings growth that we're seeing is, basically holding equity in other positions and booking that as earnings. And so the question is not, can you get good earnings for 1 or 2 quarters? The question is, can you get it persistently? And if you think about 25% earnings growth, which is roughly what's priced in the 5-year expectation, in order to get 25% earnings growth in an economy that's growing at 6-7% nominal, you either have to have one of the most extraordinary expansions in margins ever seen in recorded history, which will crush workers, or you have to have some sort of productivity boom that has never been seen in the history of humanity. So look, could that happen? Sure, anything could happen, right? But the idea that extraordinary is priced as consensus, that's the problem right now.
When you look at, though, what's going on in the memory makers, the memory supply shortage is going to last and persist into 2027. DigiTimes has had a whole article about this. Doesn't that set up, at least at minimum next year, to be an expansion of the AI trade?
Certainly, you're getting good nominal growth out of that sector because there's supply constraints. But the question is, who's paying for it? I mean, we see, as an example, the relationship between all the AI-related names. So you have, OpenAI is basically financing Microsoft's entire cloud operations, right? And so the question is, okay, so if that's what's happening, everyone looks at Microsoft and says, oh, things are going great. But then you're like, oh, it's actually OpenAI that's by and large financing that. And then the question is, who's paying OpenAI the type of cash that is being priced into the expectations there that eventually make themselves to Microsoft? And the question is, will the real economy pay for the type of expectations that are being built into the CapEx expectations in the various sort of core providers? And that's the real question, particularly in an environment where we're starting to see challenger models that are just a hair off, the frontier models that are what, 1/100th, 1/1000th, 1/10,000th the price to accomplish the same outcome? Like, why, if you're in corporate America, would you ever pay for a frontier model when you get something slightly less efficient for 1/1000th the cost?
Bob, let's finish on the bond market. We talked lots about the Federal Reserve at the start of the program. Are we on the brink of this bond market becoming a problem?
Well, I think that's one of the questions is, how does this leverage bubble pop? And typically when you look through time, it's all about the bond market. And so I think one of the things when we see Secretary Bessent come out and try and sort of distract from the core issue here, the core issue is there's too much bond supply, yields are rising, and while he's often sort of moves around in terms of what he focuses on in terms of the markets, you know what he should be focused on? The gold market. Because if there's one thing the gold market is saying, it's saying cut out the nonsense, deliver the issuance that's necessary, reprice the bond market. And instead, he seems very cautious, along with his friend in the Eccles building, to actually deliver the type of policy that's necessary to make the adjustments that this economy needs.
I thought it was an inspired choice to run Treasury at the time. Still think that in many ways. He understands the situation we're all talking about this morning in places like Japan, in the Treasury market. Do you sense he seems rattled in the last week in a way that he hasn't been previously?
Well, I think he's a man of markets, right? And he can see what's going on across the markets. And when he sees that simply from a Fed hold, you see the long end move a point or two and then keep going, that's a real concern. He understands that. I mean, his work, it's odd that he's getting worked up about using the Fed to finance the Japanese intervention, because obviously he's going to do whatever it takes in order to not have pressure on the long end of the bond market as the Japanese intervene. And so I think what's rattling him is the markets, and the markets are sending a signal. If the Fed doesn't deliver the tightening that's necessary, if the Treasury doesn't deliver the duration that's required, then what's going to happen is the bond market is going to correct this market environment, and that would be quite an unfortunate event for him if that comes right into the midterms.
Bob, it's good to see you. Appreciate it. Bob Elliott there of Unlimited Funds. Bramo, 30s this morning, still around 520.
That's not a number that makes him happy. I'm talking about Treasury Secretary Scott Bessent, and probably he really isn't happy about a lot of the reporting and skepticism that maybe this is getting away from the Fed's control.
And you guys talked about at the top of the program where the issuance is coming from this Treasury Secretary. This was an individual that used to go after Treasury Secretary Janet Yellen when she was issuing on the front end. Well, they're going to end up doing the exact same thing.
Persistent 6% budget deficits wouldn't be a problem if the biggest companies on the planet weren't in a competition to raise capital. Persistent 6% budget deficits wouldn't be a problem if we didn't face substantial spillover risks from places like Japan. But that's the backdrop right now, and we now have a Fed chair that's looking to make a big transition. It's not for me to say whether that big transition is right or wrong, but it comes with consequences, and we're experiencing the risk and the consequences in real time in the past week.
One of the discourses that has been taking place over the past couple of days has been how quickly can the Fed lose credibility, and what's the cost for them to gain it back? And I wonder how much what we're hearing from other Fed officials over the past couple of days indicates they might be willing to go further, potentially, to get that credibility back in order to peg some of those yield moves that we've seen.
5:18 on 30s this morning with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Iran says it's reached an agreement with Oman on a proposed shipping route through the Strait of Hormuz. Both countries have been in talks for several days. An Iranian Foreign Ministry spokesman did not mention any role for the US in the discussions. Chip giant SK Hynix rocked by another flash crash. Shares falling by the daily limit of 30% in the pre-market on next trade, the one-year-old pre- and post-market bourse. The incident raising fresh questions about trading volatility in South Korea's equity market. Investors racing for another potential hit to SpaceX shares later this morning. More than $100 billion worth of stock is set to become available for trading. The lifting of the first tranche of restrictions on insider share sales comes after SpaceX's first quarterly earnings report triggered a slide. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Up next on the programme, the final stages of a deal.
I'd rather make a deal because I don't want to kill people. We were all set for the biggest attack since World War II. And they called me and they said, please don't do it. Let's talk. And then they said, we never said that. But we are talking. Let's see what happens.
Up next, the former Deputy National Security Advisor, Victoria Coates, live from New York City this morning. Good morning. The record-breaking rally stalling just a touch in yesterday's session. This morning bouncing back by 0.2% on the S&P following what was the best four-day rally we've seen since April 2025. In the bond market, 2s, 10s and 30s shaping up as follows. More data later on this morning. Jobless claims at 8:30 Eastern Time. 2s around 4.20, 10s around 4.62. And the one board Bramo wants nothing to do with crude. WTI and Brent this morning.
Correct.
Just holding around 80. Lisa, 79.89. On Brent.
I mean, honestly, how do you get to interpret this? How do you say this has to do with talks or not talks or questions about a deal that's been agreed between Oman and Iran? By the way, unclear whether that path has been sanctioned by the U.S. and exactly whether this is going to be long held. Either way, it's more of the morass. Either way, you have not seen oil prices go materially higher, and I think that is a story that people are looking for.
You're going to love the next 5 minutes. Under surveillance this morning, the final stages of a deal.
I'd rather make a deal because I don't want to kill people. We were all set for the biggest attack since World War II. And they called me and they said, please don't do it. Let's talk. And then they said, we never said that. But we are talking. Let's see what happens. As soon as this situation ends with Iran, oil is going to go down to the floor. Gasoline's going to go down.
So here's the latest this morning. Iran claiming it's close to a final agreement with Oman for commercial shipping through the Strait of Hormuz, with the caveat that the U.S. Annmarie must first fulfill its prior commitments.
Yep, and they don't want really Washington involved in terms of this new navigation route. Now, these talks between Iran and Oman have been going on for days, and as we enter, really, we're in the 6th month of this war. This has been really the focal point of the entire reason why you can't get back to the negotiating table, and it's the control of the Strait of Hormuz. Now, we're still waiting on a lot of details, though. What ships can pass through? Do you have to pay some sort of toll? Does this toll get distributed amongst Omanis and the Iranians? We still don't know a lot of this information. At the same time, Jonathan, the president is talking about why he decided to not go after Iran. Washington Post this morning, front page, Trump's frustration over the Iran war boiled over at Camp David last week, where he demanded answers from Pete Hegseth and why he had apparently been misled on extreme munition shortages. The United States would need the Strait of Hormuz to open very quickly if they are dealing with extreme munition shortages.
What exactly is influencing the approach here? The former Deputy National Security Advisor, Victoria Coates, writing the notion that the Iranian regime is playing three-dimensional chess is a complete fiction. Get the strait open, keep the pressure on, and let nature take its course. Victoria joins us now for more. Victoria, welcome. We've had several deals, agreements to reopen the strait, and they haven't been sustainable. Are the conditions in place this time to make sure this actually happens?
Well, good morning, Jonathan. Yes, I think they are. We've also had some very interesting reporting from the Wall Street Journal and Javad Zarif, the former foreign minister of Iran's piece in Foreign Affairs last week, saying that Iran is actually concerned that they have overplayed their hand in terms of their control of the Strait. And so the deal that Annmarie was talking about, this one may be a little bit different because we have the entire GCC lining up behind it. So all of the countries in the region, the major energy producing regions are supporting this deal. They think it's a good deal. They think it's the right one for them. And so if we can get to this deal for 60 or 90 days, I think 90 days would be ideal, then we can get down to the brass tacks of negotiating over the nuclear file.
Can this deal go through, though, if Iran demands a toll?
Well, that's going to be a big question. I mean, what I've seen is that there's not going to be a toll, that they would get sanctions relief, but they would not get a toll for the individual ships. And I do think the GCC would be extremely cautious about a toll because that would set a precedent that they wouldn't want. Then they would have a very hard time coming back to Iran in 60 or 90 days and saying, we don't want to pay this toll anymore. Much better for them, don't start paying a toll, and then that's sort of off the table, if you will.
Isn't that one and the same, though? The United States is basically giving in if they're going to be lifting sanctions on a regime that is going after U.S. service members in the region?
Well, I mean, if there's one thing about lifting the blockade and allowing the sale of oil, but keeping the rest of the sanctions on the economy. And that's something else that, in this case, Reuters is reporting that some of the internal mechanisms that Iran has been using to try to sustain itself during these very painful times are starting to break down. This is the National Iranian Oil Company, NIOC, the National Development Fund, the NDF. These things are what they've used internally to try to keep their economy going. And now you have, accounts of the NIOC being frozen. You have the NDF saying, we just can't pay back the $17 billion that we've laid out. That's supposed to be their sovereign wealth fund, the NDF. But they've been using it as a slush fund. And now it's starting to, come due. The $17 billion it's laid out over the last year or so, they can't pay it back. They can't get that money back. So I would say keep the rest of the pressure on the Iranian economy, even if we have to give a little bit on the oil exports.
Victoria, the story that Annmarie was mentioning before in the Washington Post, and there have been other reports similarly talking about the depletion of ammunition in the United States and how that is increasingly a factor as to how much President Trump really pushes against Iran and how much he decides to go on military action. What do you make of that in terms of the depletion of ammunition and how important it is to replete it and how big of an influence that is?
No, this is a really, really serious issue, Stephanie. This is, what's been happening on terms of deferred maintenance for our military for just far too long. And so this is why the current NDAA process that's going on, the National Defense Authorization Act, which has gone over to the Senate, the president's request this year was $1.5 trillion. It's a huge sum. It's historic. We've never had that large of a budget for the Department of War. But it's necessary right now because we are depleted from the war in Ukraine. We are depleted through this action. We need to restock all of those long-range defensive munitions that have the THAAD and the Patriot interceptors that have the stocks are low. That is a fact. And so that it can be a constraint to some extent. My understanding is we have enough to do the kind of attack the president wanted to do, but we have to be mindful about our long-term prospects. And that's why we need the Senate to act. We need to get going with this large Department of War package and replenish those stocks.
Victoria, always good to catch up with you. Thank you, Victoria Coates, there on a very serious issue. And I have to say, these leaks are increasingly becoming a bigger and bigger problem for this administration. That is not what they need when they're in negotiations with the Iranians.
President Trump threatening jail time for people who are leaking. At the same time, the stories are getting that much more detailed and that much more specific about the weapons and who's saying what.
Coming up next, we'll catch up with Gil Luria of D.A. Davidson as SK Hynix is hit with a second 30% flash crash in about a week. Live from New York City. You're watching Bloomberg TV. equities this morning firmer by 0.2 on the S&P. Bit of a weight to the tape on the Nasdaq and tech. We're down by a third, but what a run we've seen over the last week or so. Going into yesterday, that 4-day run, something like 5.75% higher on the S&P 500. So you look at that this morning, just a bit of perspective, some context, no drama in the equity market this morning. In the bond market, 2s, 10s and 30s look like this. Focus on 30s. 30s closed last week after the Fed meeting last Wednesday at 520. We're holding on to those levels. We're at 517 this morning. The data is going to take on increased importance through the week when we get to payrolls. Looking at the data so far, take a look at the soft data, the survey data, the ISMs on manufacturing, 4-year high. And you looked at the employment component and that flipped positive. The ISM services read in expansion still, but that employment component flipping negative. And maybe that introduces just a little bit of downside risk into the payrolls report on Friday.
Yeah, especially when paired with ADP. That might be where the downside surprise actually is coming from, is those service jobs that were taken off. Really notable how much this contrasted with the ISM manufacturing. The other notable thing is if someone was worried about stagflation or stagflation light, this report would really worry them, because you saw an expansion of prices paid at the same time that you saw a contraction of the employment index. You start to wonder, how do you deal with these? I'm not saying that the conflict is between the dual mandate, but you know, it's kind of the conflict being.
Nela Richardson of ADP is going to join us shortly, and she's going to tell you why you can get paid so much more if you switch your job. You looking forward to that conversation?
I actually saw that. It's been like the fastest pace of job growth in a long time. I feel like everyone, Mike McKee yesterday, this.
Right.
Maybe explore something new.
Nela coming up a little bit later. Looking forward to that. Counting you down to the opening, about 3 hours away with some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing Sandex shares falling more than 9% in the pre-market after the company gave a first quarter revenue guidance that missed analyst expectations. But otherwise, the quarter was strong for the flash memory company. Management said about 2/3 of last quarter's revenue growth came from higher pricing, not just higher volume, suggesting supply remains tight and these companies still enjoy excellent pricing power. But after the stock had rallied some 470% year to date, the market was looking for even more from the S&P's best performer this year. Western Digital has also enjoyed a huge run, up some 200% this year. So it's also falling victim to high expectations. Shares are falling nearly 15% in the pre-market, even after it beat on the top and bottom lines. But its first quarter revenue forecast missed the average analyst estimate at the midpoint, suggesting the market continues to punish these companies, these high flyers, if they don't have perfect results. And we end on software with Figma shares. They are also falling some 15%, even after it delivered a beat and a raise. And the problem here is it's growing AI-related expenses, with that spending materially pressuring free cash flow and its margins. And look, more broadly, as we've talked about, the software sector has recovered nicely from its spring lows, but this reaction shows that investors still appear to be a bit jittery on the sector, and they are quick to punish bigger CapEx plans if they don't come with nice returns. John?
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, hedge fund, situational awareness, making another big bet just days after it was on the brink of collapse. According to people familiar with the matter, the founder making a $400 million investment in a privately held company on Tuesday. Elsewhere, about $100 billion worth of SpaceX shares set to hit the market. An agreement restricting insider share sales coming to an end. Over 900 million shares will become available for trading when markets open later this morning. And finally, SK Hynix rocked by another flash crash. It's second in about a week. Shares hitting a 30% pre-market limit down, followed by a 10% slide during Thursday's session as major volatility raises once again fresh alarms.
Yeah, so here's the issue. At what point is this a structural market structure type of issue? And at what point is this an SK Hynix and a memory chip issue? The answer is unclear. It was a number of shares that were traded on NextTrade, which is the first licensed ATS, or alternative trading system, in South Korea. It started in 2025, so it is just about a year old or less than that. And it's sort of coming under fire for exactly the pricing system that it's using to evaluate exactly where SK Hynix should be priced. Now, here's the issue. SK Hynix is one name in South Korea. Why do we care here in the United States? This is actually injecting a lot of volatility internationally on the chip names, on just the levered tech bets all around the world. So you start looking at that and you start saying, hold on a second. This ATS that got licensed in 2025 might be driving a whole bunch of volatility in tandem with leverage and a lot of speculation.
And when it comes to volatility, and maybe this prompted what's going to be going on with next trade, come September 14th, they're actually going to put a mechanism in place. So some of this actually could be dealt with when it comes to all this volatility. Bids at least 10% above or below the previous closing price, this mechanism will automatically be triggered.
Mandeep Singh of Bloomberg Intelligence can build on this story. He joins us now for more. Mandeep, do we have a fundamental problem here that we need to clear, or a market structure problem?
I think it's more the latter, market structure. I mean, fundamentally, we heard from the hyperscalers this earnings season that they are seeing an acceleration in their cloud growth. And all of the AI infrastructure names actually have very solid fundamentals coming out of 2Qs. So from that perspective, I think we're talking about probably an increase in CapEx relative to where consensus expectations are. And, the supply chain seems to be still constrained when it comes to supplying these components. So whether it's memory or storage or anything else at the chip level, it's still constrained. And fundamentally, I don't think anything has changed. And on top of that, you have seen the model companies like OpenAI and Anthropic really ramp up their ARR. They've come a long way this year, and the momentum has continued. So I would say the fundamentals remain solid here.
Mandeep Singh of Bloomberg Intelligence. Brahma, I think to some extent you nailed it. In fact, I think you did. Importing volatility from South Korea is something new for the US equity market and something we've experienced most of this year now.
And it speaks to the lack of understanding of how to value some of these companies. I mean, ultimately, the memory chip sector seems like it has the biggest moat of all, which is people can't produce enough memory, and it seems like those supply shortages are going to be in perpetuity. At the same time, when margins get that fat, people start creating competition. It's one beauty of capitalism.
85% is an invitation.
It's saying to you, you too could have this money.
Without a doubt. Gil Luria of D.A. Davidson writing, investors are worried about open source models, circular financing and increased competition. We're cautious on semis trading at valuations that imply the cycle will continue. Gil joins us now for more. Gil, are you implying the cycle won't continue?
I wish I knew. That would be really great, but I don't. Our sense is that the demand for AI is going to continue to grow, and therefore the investment cycle will continue. And what we heard over the last couple of weeks is the hyperscalers have at least one more year of higher CapEx in them. So we know that much. Whether it continues after that really depends on the continued progress on AI and its adoption, which is something that we all would like to know, but it's very hard to predict. So all we could do is focus on what are the situations where stocks are trading like the cycle is over? What are the situations where we're trading like the cycle has to continue to 2030 and beyond to justify the valuations? And you're talking about one sector where the market's already trading like the cycle is over, which is memory. So in spite of the fact that we're not getting any new supply for at least another year, probably more, and that supply probably won't be nearly enough to meet demand, these memory stocks are trading now at mid-single digit PE ratios, right? And the market is having this really tough challenge of saying, wait a second, SanDisk, which is trading a mid-single digit PE, isn't going to grow more than 300%. It's going to grow only 300%, meaning it's only going to quadruple next quarter, and not knowing what to do with that. That's, to us, where the opportunity is, and then we just focus on the high end. We don't need to focus on SanDisk and Western Digital. We can focus on Micron. On the other hand, there's these group of stocks that is trading like the cycle will continue forever. Your Intel, your Cerebras, some of these optical stocks, semi-cap stock, to justify the types of multiples those companies are trading at, you'd have to believe that the cycle still has a long way to go. So we'd rather just stay at the near end. We feel like there's another year of CapEx. That's good for NVIDIA. That's good for Micron. It's good for AMD. extrapolating beyond that is where I think it gets really tough. You really have to make assumptions that are very hard to make right now.
It's one thing to analyze these companies fundamentally and the runway, which is difficult enough in its own right. But Gil, we were just talking about market structure issues and leverage being built up in different places, the idea of new trading systems that are getting deployed during a unique cycle. How much more are you focusing on those things in addition to just the fundamental questions that are complicated enough in their own right?
Yeah, I think your conversation you just had earlier was spot on. I never imagined that I'd have to know so much about how many Koreans had their brokerage accounts shut down because of margin. And now this is what drives our market. And it just happens. It's a little bit of a coincidence of history. The two of the biggest memory companies happen to be in Korea, which is a nice, big, growing, healthy market with a lot of other things to offer. But those two stocks are way too big for the Korean market, way too big for the liquidity, and as it turns out, way too big for the market structure that they have. And yet, to your point, they are very much linked to our market. SK Hynix is linked to our market through an ADR, which makes it even worse, but also because it's such a close comparable to Micron and the rest of the memory complex. And by definition, when one of those moves, the others are going to move. So yes, it's become a factor. I would expect that the ADR is going to actually help. You can see that the move in the ADR in the pre-market is less than the move in Korea. Those have not moved exactly as you would think in line. Our market is behaving a little bit like a cushion, like a dampener. And so I think this is going to work itself out. It's just highly unusual that we have $2 trillion companies in a market that's just not well suited from a market structure perspective to absorb that.
There's a bigger issue here, though, too, Gil, and it's something that we keep talking about following situational awareness and the blow-up of that fund. Is that sort of the entirety of the problem or a big fish that really was causing a lot of volatility? Or is it a symptom of all the leverage that's been built up that could potentially roil stocks that have a great fundamental story, but perhaps have been inflated at a time of ebullience?
I think it's all of that, but it's not. Again, I'm arguing that these valuations aren't inflated. When a company that still has growth is trading at 6 times earnings, it's hard to say that the valuation's inflated. The moves have been extreme. Stocks that are up 10 and more times in a very short time frame have created a lot of gains. A lot of investors that are day-to-day traders and want to get out of positions quickly. And this is all getting amplified, again, by Korea, by the volatility here, by the extreme moves, by very, very high expectations. And it's creating this very, very unusual volatility. Again, companies growing 300%, trading at 6 times earnings isn't something the market is used to. So it's very hard. And that have already gained 1,000 or 10,000% in a short period of time. Those are not things the market is used to handling. Discussion between 22 times and 24 times earnings. It's not used to dealing with this type of volatility, this type of fundamental changes. And so we just have these extreme moves in fundamentals, extreme moves in stocks, and that's creating volatility. That doesn't mean that these valuations are inflated. Again, I'm arguing there are parts of the market, parts of semis that valuations are inflated. It's actually not memory. The volatility is just because of those extreme moves.
Gil, it's good to see you. It always is. Thank you, sir. Gil Luria there of D.A. Davidson on the chip sector right now. Obviously, in South Korea, there was a massive build-up in leverage. And clearly, situational awareness used a lot of leverage and the market moved, flipped, and they were on the wrong side of everything after being on the right side for quite a while this year. The question I've got, and Peter Tchir hopefully is going to help us answer it a little bit later on this morning, is how much of the weakness in chips through July was actually just down to the blow-up of that one fund? Because that's what people are using potentially as a convenient excuse to start buying those chip names again. I think that's the conversation we've got to have a little bit more.
It's a conversation the market's having right now because in 4 days, the semiconductor index in the United States, the Philadelphia Semi Index, gained the most for those 4 days going back to 2020 in March. So it gives you a sense of just how extreme these moves have been. How do you go from oversold to overbought in 4 days? Well, this is what it looks like. And what does that speak to? People's fear of missing out and fear of being a little bit too late in getting out.
Peter Tchir coming up in about an hour's time. Up next on the programme, we'll have more on the situation in the job market, more data coming up a little bit later. For now, let's get to your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. The Wall Street Journal reporting President Trump has repeatedly called Kevin Warsh since Warsh took on the role of Fed chair. The president reportedly seeking counsel on a range of matters, including the war in Iran and the rapid rise of AI and how it's impacting the economy. Google is concentrating its AI leadership. Top AI executives have been appointed to work at Alphabet's Mountain View, California headquarters to gain momentum in the accelerating race against Anthropic and OpenAI. Google aiming to reverse trends that have complicated decision-making and frustrated talent. Chinese AI leader DeepSeek is planning significant price hikes across its services. The startup not specifying the exact amount of the increases, but referring to them as substantial and urging users to plan accordingly. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, mixed data facing the Fed.
If the unemployment rate starts moving up again, then it will no longer just be a question of what's the right rate to set for inflation. Then you'll be concerned about the labor market. We think we're in store for some weaker reports upcoming.
Nela Richardson of ADP joins us next, live from New York City. You're watching Bloomberg Surveillance. Stocks this morning positive on the S&P, up a tenth, down on the Nasdaq, down 0.4%. A bit of weakness in tech in the last 24 hours, tons of strength in the previous 4 days. In the bond market, 2s, 10s and 30s look like this, going into more data later this morning. Jobless claims at 8:30, 2s at 4:20, 10s around 4:62. Under surveillance this morning, mixed data facing the Fed.
It's a decent reading on the payrolls number. If the unemployment rate starts moving up again, then it will no longer just be a question of what's the right rate to set for inflation. Then you'll be concerned about the labor market. We think we're in store for some weaker reports upcoming.
So here's the latest this morning. Investors awaiting July payrolls data as mixed employment data complicates the Fed's policy path. The latest ADP employment report coming in below expectations, but suggesting those looking for new jobs are getting rewarded. Nela Richardson of ADP writing job changes are highly sensitive to real-time economic conditions, and their rapid pay growth implies supply constraints in parts of the labour market. Nela joins us now for more. Nela, good morning.
Good morning.
There's two data points that I love in the labour market. One is quits and the other is the pay that you get for switching your job, because I want to see confidence in the labour market. Are you seeing some confidence pick up slowly?
Well, a little bit. I mean, that 7% number is remarkable. We haven't seen that level of pay growth for job changers since August of 2025. So when we saw that number, it jumped out to us. It was the biggest number in that report, in our view. I know a lot of people looked at the 44,000 and said, oh, that's a miss. It's not a miss for us because we've been tracking it every week. So if people were paying attention, that's where you would have landed. But what was remarkable was the fact that this labor market is tighter than job gains suggest. And so when you're looking at the number, either with ADP or on Friday, it's the why that's important. Is this a low or high number because demand is high or low, or supply is high or low? Supply is a big factor, which is why that job changer pay growth is
Can you
elevated.
flesh that out a little bit more? How much the supply backdrop has shifted in the past 12 months or so?
Probably the best way to do that is through an actual example in construction. So we're seeing the hiring rate for new construction workers high. It's the highest job changer pay growth we track. It's almost 14%. That's the highest we've seen on record. And yet the number of jobs that were created in July was 1,000. That's a big deceleration from the second quarter. There's just not enough people to hire. People are retiring out of that field. It's a field that is aging rapidly. And so what the hiring rate suggests is replacement hiring rather than new jobs. So the signals are muddled. They're not telling you what they typically tell you because a lot is going on in this labor market.
In the past, when we saw the headline number, you pull the hood back and what you get is a lot of education and healthcare jobs. And that isn't exactly a robust signal about the overall economy since it's a more static pool independent of the economic cycle. Has that started to shift at all?
Yes, we saw a deceleration, and it's mostly driven by healthcare. It's mostly driven by these aging demographics that are overlaying the entire labor market. And we actually saw this pattern last year, too. We saw a shift down in July and then acceleration in the fall. This is something that's also very interesting about the labor market. Because there's so many macroeconomic shocks and trends that are hard to call, firms are changing their hiring patterns. When they hire is not typical anymore. They're hiring strategically. It's like firms are playing dodgeball with all the macro news, and they're going to shift and shift. And so a strong hiring month in 1 month, like in spring, may be followed by a weaker hiring month, just to balance it out.
What I thought was fascinating in your data is that you show that healthcare has decelerated, but that white-collar jobs have actually re-accelerated. It's sort of this question of AI not exactly having the same kind of ramification on the business community as people previously thought.
Right, so we track this really closely. We track it with our partners at Stanford in this, what we call the Canaries dashboard. But when you look at the overall labor market, finance, information, professional business services actually increased jobs relative to the second quarter. So yes, AI is having an impact, but it's not this grand sweep of impact that is part of the popular narrative. Those jobs actually accelerated, and the pay is following as well.
Were employers caught off guard then? Because a lot of them, do you feel like they were holding back because they thought AI was going to be able to replace these workers, and they're realizing they're not, and now they're actually have to go to the market and pay even more to get that talent?
Yeah, I think employers have been caught off guard by AI, by interest rates, by geopolitics, by, consumer sentiment, a more cautious consumer. There's so many things that they're navigating right now, and that's why they're changing their hiring patterns a little differently. So when we look at a number like 44,000 in July, we don't rest there, because there's so much going on under the surface of that number.
How much also is it that employers have to pay up because they have to not just attract new talent, but also keep in line and some with inflation?
The competitive environment for, especially in places where there are supply gaps, is really extreme, because you're not just talking about a local market. You're talking about a national, sometimes global market for talent. This hybrid work thing is a real factor now. It's a live factor. And so not only do you have a wider talent pool as an employer, so does the person you're trying to recruit. And we know from the research that we're doing, the way workers outpace inflation is to change jobs, because you get that pay bump. And so if inflation is higher than normal and the competitive landscape in some sectors is tighter than normal, you are going to see that kind of acceleration in pay.
Nela, this was fun. We appreciate it. Thank you very much. Nela Richardson there of ADP on the tightness in this labour market. I think this is important. The tightness of this labour market below the surface, beneath the surface of the headline jobs growth we talk so much about.
When we got JOLTS data, you could say it came in a little bit in a disappointing way, but the quits rate actually came in above expectations. Similar with the ADP report, the actual headline number came in below people's expectation. But you see these metrics showing that people actually have increasing leverage as employees over their employers, which signals some kind of shift from just this low-fire type of dynamic.
It's a shift worth watching. 14%, not bad, is it?
Yeah, I think I need to start bulking up.
Oh, you want to start?
Yeah.
You want to start getting into construction?
I managed to fix a toilet, so I'm going to keep trying.
You can be a plumber on the side.
I know.
With YouTube, you can do anything.
It's true.
Ramo is so skilled.
Yeah, I'm just skilled labor.
So skilled. Coming up next, Jonathan Golub of Seaport Research, plus Brian Hamilton of LiveSwitch on SpaceX, and Al-Hussainy of Columbia Threadneedle on this bond market. Your equity market this morning on the S&P firmer by about 0.1% on the S&P 500. Yields up a single basis point. Your 10-year, 462. Your 30-year, 518.
The overall sentiment is not great.
Yields are going to fluctuate for a while.
The 30-year is going to be driven in large part upon where the deficit goes.
The front end is clearly saying they want to hike.
We've had to price in going from a dovish Fed now to a hawkish Fed to now to an uncertain Fed that might be losing control of the long end of the yield curve.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now with your equity market and your scores shaping up as follows. We look like this morning, up a tenth on the S&P, looking to bounce back from some very mild losses in yesterday's session. A bit of weakness on the Nasdaq, down by 0.6. Some underwhelming earnings from SanDisk overnight, taking that stock lower in the pre-market by 11% and sparking to some extent, to some degree, this move on SK Hynix, a 30% flash crash in the pre-market in South Korea, recovering and then down on the session and down hard. We've seen this movie a few times already.
Yeah, and it kind of flies in the face of people who are saying that maybe the leverage is out of the system. Now we have a nice calm market that can give predictable returns. Well, South Korea has indicated maybe that's not the case, and it has been the case that there has been an incredible amount of volatility in that market for quite a while. There's a bigger question here, which is how much has the volatility been driven by fundamentals and whipsawing views of exactly what the runway is for some of these earnings, and how much has it been driven by fundamental market structure issues, whether it is what's going on with South Korea with leverage, whether it's some of the way that these new exchanges operate, or whether it's just the whipsawing of positioning as people try to get ahead of the next new thing.
There's some of the jitters in tech right now. Let's talk about some of the jitters in the bond market. 2s, 10s and 30s shaping up as follows. Yields higher by a single basis point across the curve. 30 still around 520. Heading into this data later on this morning, 8:30 Eastern time, we'll get some jobless claims. And the backdrop for that data for this bond market is a Treasury Secretary that's sounding increasingly nervous about what's developing in fixed income.
Yeah, and so nervous that he's going after journalists that track the Federal Reserve. This was the Wall Street Journal's Nick Timmerose, said he's reduced to reporting Fed backroom gossip because they're incapable of performing real economic or monetary policy analysis without being spoon-fed. And you made the great point earlier, Jonathan. No one is obsessed with the fact that we don't have forward guidance anymore, or we don't have Fed whispers anymore. People just want the Fed chair to come up and explain his reactionary function. And this is always happening at the same time. The Wall Street Journal front page says that he's taking calls from the President of the United States. Does the President of the United States understand what his reaction functions are? Well, the rest of the world should as well.
If Kevin Warsh is going to take a new academic look at what exactly causes inflation, of exactly what the neutral rate is, of exactly what the most appropriate interest rate tool is to really control inflation, why is this getting so emotional? Why is this getting so personal? Why does this become a name-calling exercise, not only by certain people in the administration, but also by places like the Wall Street Journal editorial page? It just goes to the question, how do you have an honest conversation about reaction function versus forward guidance versus exactly what the measurement tools are when you're starting to say that so-and-so is just a stenographer, or grow up, you crybabies on Wall Street?
This is the chairman of the Federal Reserve, and they're treating him like a child. It's not baby Kev. It's Fed Chair Kevin Warsh, not baby Kev. Why have we got a load of people coming out defending him after a few months on the job? I don't get it. This is so juvenile right now. The complaints about the Fed chair are pretty valid. They're big questions that need to be answered. I don't think they've been emphatic. I don't think anyone's come out and said, I'm so upset that the forward guidance is ending. I need to know what they're going to do at the September meeting.
I haven't heard one person say that.
What am I going to do? Yeah. I don't know what to buy. I'm just going to pack up and call it a year. No one's saying that in financial markets. Why is everyone getting so fired up about this? They're just saying, OK, new guy at the Fed. I want to know what he thinks about the economy, what he believes are and aren't sources of inflation right now. That seems like pretty important stuff we should discuss. And if you are committed to inflation, getting back to target, what tool are you going to use to get it back to target? Is it the interest rate or the balance sheet? And if you're posing these open-ended questions and you don't really know whether it's the interest rate or the balance sheet or whether you're going to outsource it to financial markets, then hello, we're going to have a problem further out the curve. And guess what? We already do, for a bunch of reasons. And if you're the Treasury Secretary right now, is that the kind of move you want in the bond market at the moment? Because based on how you've responded to the situation in Japan, you seem very concerned about what's happening in Japan at the moment, and I don't think it's because you love the Japanese. I think it's because you're worried about what might happen in fixed income.
The scariest move right now on the bond dashboard, potentially for the Treasury Secretary, is the term premium on 30-year bonds, which has reached the highest level going back to 2008. This indicates this concern about what exactly is the reaction function and exactly how much confidence do people have in this administration to get inflation and, frankly, credibility back.
I'm distraught. It's the end of forward guidance.
I keep wearing black.
Deeply emotional about it.
I think that it's
just so upset.
I feel lonely
About the end. Like you ask serious questions about the economy and then get accused of being upset about the end of forward guidance. That just seems
Obviously.
ridiculous.
I know, that's the point.
Sounds like
right?
gaslighting.
Why?
Totally. That's exactly what it is.
And that's the reason why I think we have to keep focusing on what the actual issues are and trying to steer clear of name-calling.
It's deeply emotional, Bramo. It's upsetting.
I think that bonds are.
Look, I didn't like the Powell groupiness either, by the way. Like, the groupie stuff on Wall Street with Chairman Powell was never a fan of, at all. In fact, I despised it. And I think a lot of people love the former Fed chair because they all made so much money. I think the Fed chair made some mistakes, some big mistakes at the best of times. Let's be consistent about it, though. This guy's not performing great in these last few press conferences. He seems a little bit rattled himself. I have to say he seems a little bit out of place for a lot of people who described him as central casting. I don't think he's sort of dominated and held that lectern in a way that gives me any confidence if I was in this market at the moment.
I want someone who's self-reflective, who's able to say what they think and then to amend it, to potentially be self-questioning. And if you're not getting anything at all, it's unclear that that actually is the reaction function on a personal level.
Lisa, he's been in a 10-year audition for this job, and he looks like a man who hasn't worked for 10 years. I hope that by the time we get to Jackson Hole in the September meeting, he's in command of the conversation once again. But he's not in command right now, because if he was, you wouldn't need the Treasury Secretary coming out and behaving as your daddy on X, pointing to different journalists and telling them what they're doing wrong. I think Kevin Walsh has been around. He doesn't need that from the Treasury Secretary. To be honest with you, it's pretty embarrassing.
In the meantime, the oxygen's being filled by the other Fed officials, and they're coming out and saying probably a hike is more likely in the offing.
We'll move on. Coming up, Jonathan Golub of Seaport with the latest tech-led rally taking a breather. Brian Howardson of LiveSwitch with billions worth of SpaceX stock set to unlock. And Ed Al-Hussainy of Columbia Threadneedle as the Fed's family fight deepens. We begin this hour with stocks looking to regain footing as chip concerns are weighing on momentum. Jonathan Golub of Seaport Research Partners has an 8,200 year-end price target while favouring the tech and financial sectors, writing, "This is the best earnings season with massive beats and growth rates. The trends are all likely to persist." Jonathan joins us now for more. John, good morning.
Good morning.
Does the Fed even matter? The earnings are so great.
I mean, you're talking about how people are communicating. First of all, he's going to get his footing, and we're not going to be talking about these issues. The real question on this, but the real question is there inflationary pressure in the system? Yes. Are we running such huge deficits that the likely course of the 10-year or rates in general are going to be higher? Yes. Is that a problem for Besson and the Treasury? Yes. Is he intervening in Japan because, like you said, because of Japan or because they are the biggest owner of treasuries? And if they have a hiccup, it's going to move the long end of the U.S. curve. Yes, and that's a debate, whether or not he's central casting or not central casting or forward guidance. It's all about the economics and everything else is noise.
I could not agree more. It's that issue in the bond market that's developing, and it doesn't have to develop into a crisis. I sure hope it doesn't. Is it a problem for stocks, even with earnings this great?
It is, because what's happened with this AI trade, I hate to call it a trade, with this build out of data centers and the like, is that we've extended the duration of equities. We don't know, you have, high cash flow companies that all of a sudden are investing for a new future in the way that technology is going to affect our lives. And that means that the payback on these companies is going to be further out in the future, which means they are more sensitive to the 10-year Treasury than they would have otherwise been. That's number one. Number two, if you are in an environment where we are, as a society, raising trillions of dollars to fund this build out, if the Fed needs, because they're running such huge deficits at the government level, also trillions of dollars, they're competing with each other. And that kind of competition for capital means that you're probably going to see higher interest rates.
So there are two sides of this. On one side, it's a valuation question. What is the appropriate price to equity ratio, given just how much higher yields are currently? And then also, at what point do higher borrowing costs constrain some of these ambitions? On the first side, do you think that price to equity ratios have to be substantially lower in this new era than they have been in the past when people are taking a look at previous models?
They are lower. I mean, if you look at from the beginning of the year to now, the stock multiple on the S&P is down about 2.5 to 3 multiple points. I mean, the earnings are up this earnings season. This can sound crazy, and some of these numbers are kind of fake numbers because you had unrealized gains that were realized. If you strip out all of these weird unrealized gains, earnings grew 30% this quarter. Normal is like 8 to 10, and the stock price on a lot of these companies are not moving up, or if they're not moving up commensurate. So you are seeing multiples come down substantially. The average company in the S&P is in line with its 30-year average. The tech basket has become cheaper than normal. Yet you're 100% right that they need to correct, but they kind of have already.
Well, I mean, but this sort of goes to the potential upside, too. How much is the potential upside limited by the idea that price to earnings ratios are potentially lower in this new era? In other words, they don't have to go normalize because this is not a normal period of time.
So first of all, I'm very optimistic about this story, but you always have to focus on what can go wrong. This environment needs the ability to raise capital in order to move. If the Fed tightens, and we're talking about the Fed raising rates, the hyperscalers will borrow money at any cost. The Treasury is going to have to borrow money. So the question is, who gets squeezed out by tighter financial conditions if they show up? And it's small businesses. So I think the risk in this, just think about this. If you have a hyperscaler bond and they want an extra 50 basis points of yield, they're going to borrow at that yield. The Treasury is going to has no choice but to finance the Defense Department and interest expense and the like. So who's the individual who says maybe I can't afford this extra loan? It's a local business in your community that's financing payroll or inventories. And I think that if we get squeezed on financial conditions, it's a small business guy. So I think, and we've talked about this on the show before, what's the political ramification for this? If you have, and I'm not saying that we will, but if you have a tightening of credit conditions, I think there are going to be a lot of ramifications for that. Right now, by the way, if you look at all the data, the reason companies are raising money is because the markets are open and access to capital is fine, and all this is going swimmingly well, but that's why this debate is important.
Well, this Treasury Secretary has said time and time again that they want to focus on Main Street because Wall Street has done well. If they hike rates and they just hurt Main Street, then what's the point? Is that a good enough excuse for this Fed to say that is a reason why we are not going to hike interest rates?
As long as you're willing to, it's a double-edged sword. Yes, I think that if you tighten rates, I think you're going to end up hurting Main Street. If, on the other hand, you don't hike rates and you get inflation, then you're hurting retirees by increasing their costs. Here's the bottom line. We're running a federal deficit that doesn't make any sense for an economy that's this strong. We've let this thing run ahead of ourselves, and there's eventually a cost to this. Now, mind you, I'm not bearish. I think that we are in this environment that none of us in our careers have ever seen before. The amount of investment in infrastructure and future growth is amazing. Final sales this quarter was 3.9%. I don't remember anything like that. That said, you have to focus on what where the real debate is.
In fact, the competition for capital right now, the fact that we have a stimulus program conducted by the biggest companies on the planet in this economy, makes that deficit make even less sense at the moment because the stimulus program is on, and it's being funded by debt issuance in the credit market and the monstrous spending from the Microsofts, the Metas, the Amazons, the Alphabets of this world.
That's why there's so many fiscal hawks right now down in Washington, D.C., looking to cut the budget. Oh, wait, yeah, there are none. So this isn't going to exactly go away anytime soon.
The hypocrisy is just, honestly, overwhelming, isn't it?
Instead, it's sort of, how do we expand the budget even more?
All the things that you would complain about if you were out of power. Then you get into power and you carry on doing precisely the same things.
The discipline tool is the bond market. Can't fool the bond. And at what point does it have a moment?
of discipline.
John, I'm happy to say you're going to stick with us. Jonathan Golub there of Seaport Research Partners with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Hedge fund situational awareness has returned to the investing scene. Sources telling us here at Bloomberg the founder is making a $400 million investment in an undisclosed privately held company he already had an investment in. He pledged to investors that the recent events that saw his fund plunge have made him wiser and stronger. Recapping some labour market data, challenger job cuts showing companies laid off more than 33,000 jobs last month. That number down 46% year over year and the lowest monthly total since July of 2024. Fed Governor Lisa Cook says she's ready to raise interest rates if inflation doesn't slow. Speaking at an event in Alaska, she cautioned that the longer inflation remains above the Fed's goal, the tougher the job will be to rein it in. Cook says she's firmly committed to restoring price stability. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, leaning on the Fed chair.
I want Kevin to be totally independent.
Rates should be lowered. We should have the lowest interest rate in the world.
Kevin's got a board. He's fantastic. He's a brilliant guy, smart. I know he'd love to see lower interest rates.
We'll have more with Jonathan Golub of Seaport up next, live from New York City this morning. Good morning. Stocks this morning positive by 0.1% on the S&P 500. On the Nasdaq, just a bit of weakness. We're down by 0.6. Lots to talk about with big tech this morning. Some weakness with SanDisk, those earnings underwhelming. The lockup, the beginning of the end of the lockup, a staggered one, a staggered end to that lockup over at SpaceX. A big focus of this programme. We'll have more on that in just a moment. Let's turn to the bond market. 2s, 10s and 30s. Yield shaping up as follows. On 2s around 420, on 10s around 460 and 30s getting the spotlight in the last week, just holding on to levels around 520 at 518. Under surveillance this morning, leaning on the Fed chair.
He's got the whole package, and I think he's going to do a great job. I want Kevin to be totally independent.
Kevin's fantastic. Rates should be lowered. We should have the lowest interest rate in the world.
Kevin's got a board. He's fantastic. He's a brilliant guy, smart. I know he'd love to see lower interest rates.
So here's the latest this morning. The president has reportedly spoken several times with the Fed chair, Kevin Warsh, since he became the chief of the Fed. The Wall Street Journal reporting the president has asked for Warsh's advice on various topics, but it's unclear if they've spoken, Annmarie, on monetary policy.
Unclear if they spoke about monetary policy, but you know, you would need to be living under a rock to not understand where the president thinks interest rates should be going. And he has been consistent about this even before his time in office when he was a real estate developer here in New York. The story goes on to say the president calls Warsh in bursts, the people said, several times in a stretch of days, then quiet for longer periods. And he sought his counsel as he's dealing with issues like the Iran war, when it comes to AI, et cetera. I think what we all want to know is what actually is Kevin Warsh telling the president at the same time the Treasury Secretary is coming out and really coming to his new Fed chair's defense?
Look, the optics stink, right?
They're terrible.
It's a stretch to say the Fed chair's doing the president's bidding. I'm not going there. I've never implied it. I don't think he is. And if you look at inflation expectations for now, the good news is for now, they're still just about anchored. That's the good news. Though there is a risk they're going the wrong direction. We talked about this last week. After that news conference wrapped up, and the president immediately started talking about the Fed chair and how he supports the Fed chair and he's got these political actors, I don't think the optics help. Also, the comments from Secretary Besson, I don't think that helps at all either. In fact, it makes the Fed chair look weak. It makes him look weak. And I think it leads to those on the committee questioning his leadership as well. And that's problematic too, at a time when you're trying to make real changes at this institution. And I have to say, the kind of changes he's trying to make are worthy changes. Moving away from things like forward guidance, changing the way we communicate, looking at the data differently. They're all worthy changes. But you need to bring people along and lead. And what I'm seeing from Besson, what I'm seeing from the president, this reporting, it makes him look weak.
From the market's perspective, right now the committee seems to be moving in a different direction from Fed Chair Kevin Warsh in the sense that they are giving their reaction function one after another, giving a sense that it would just take a couple of CPI prints that were higher than expected, with Mary Daly saying she does get a lot of data before September, saying that should you see a quicker, broader-based inflation, maybe the question would be, why do it incrementally and potentially hike even more? So the rhetoric is coming from myriad places, but not necessarily Fed Chair Kevin Warsh.
If this was former Treasury Secretary Janet Yellen going after a Wall Street Journal reporter, I would have loved to ask then Scott Bessent, hedge fund manager, what he thought of that, because he was so critical of that Treasury, saying they were very political, they were issuing on the short end. Well, how is this not political?
It'd be seeing blood in the water and no doubt short in the Japanese yen and having to think about doing the same with the long end of the Treasury, no?
I would love to know what his positions would be. His biggest holding before he became Treasury Secretary was, I believe, gold.
It was, yeah, long gold. Jonathan Golub of Seaport, still with us. John, you touched on this, alluded to it. We won't get into the politics of the institution, we'll steer clear of that. But contributing potentially to higher long-end yields and potentially capping the upside for this market because of multiples. Can you elaborate on that a little bit more?
Yeah, I think there's a couple things. But one we talked about before, there's a competition between the capital raising that's going on in AI and the capital raising that has to be done by the government because we're running enormous deficits. I mean, we didn't talk about it at all, but if the war goes badly, and I'm a skeptic of this belief that we're going to just, every time the oil price seems to get about to 85 or 90, the president says that we're about 30 seconds away from a deal, and it gets rolled away. And even if this is temporary, I don't think Iran is so quickly going to capitulate on the Straits of Hormuz because it serves, it serves our interests. But if that would add a lot of pressure on CPI, and it's not only the headline CPI. Oil is in everything. It's on, it's on the asphalt on our roads and the roofing materials on our homes and the plastics that we use. And so if we end up embroiled there for longer, that puts more pressure on. And the Fed seems to be predisposed to wanting to tighten against that. So I think that this competition for capital is a really big deal.
John was making this point yesterday. Do you think that if the Fed were to hike rates, that would actually help equities because it would constrain the long end of the yield curve and potentially enable the borrowing that has really supported so many of these companies?
At the end of the day, it's all about the economics. I'm not really sure that for all of the conversation we have about the Fed, there's underlying economic drivers, and which is why John asked the question before: if the Fed doesn't do it, the market will have to. Well, why don't we just let the market do it? If the market believes that you're going to have to, take this inflation down a little bit, and that rates are going to, drift a tiny bit higher in the process. So I don't put as much from an equity guy. I'm not so convinced that the Fed is the be all and end all of what drives markets at all.
That said, there is concern about leverage building up. You see margin debt that reached the highest levels on record earlier this year, ahead of some of the volatility that we've been seeing. You also see potentially this idea that earnings have never been better. Margins have been expanding dramatically. A question of, does there need to be some sort of curtailing of the exuberance right now in certain pockets of the market in order to have a stable economy and, frankly, steady growth?
Yeah, I just, through my lens, I'm not seeing the exuberance. And we talked about before, stock multiples are nowhere near highs. Stock prices are at highs because companies are earning, the earnings are terrific. And some of that is margins because, these semiconductor companies are doing well. But the entire tech suite is seeing margins higher. If you look outside of tech, in non-tech parts of the S&P, they're near highs. So things are going really, and part of the reason is that we are kind of mid-cycle. Margins are supposed to be edging higher. So to try to tighten conditions because things just seem really good and make us uncomfortable. And by the way, if you generally look outside of a small number of hyperscalers, we don't have a problematic level of debt in public companies. They've delevered for a really long time.
Jonathan, always good to see you. Appreciate it. Thanks, John. Thank you, buddy. Jonathan Golub there of Seaport Research Partners. Up next on the programme, Brian Hamilton of LiveSwitch with roughly $100 billion worth of SpaceX stock set to become available for trading. Plus, Yahira has your morning movers. SanDisk and Western Digital failing to live up to sky-high expectations. Equity futures this morning just about positive on the S&P 500. No real drama in the last 24 hours at the index level on the S&P, just pulling back slightly from all-time highs following a four-day rally, the best four-day rally we've seen since April 2025. On the Nasdaq this morning, down by 0.5. We'll unpack that and get you some tech names in just a moment. In the bond market, 2s, 10s and 30s, more data a little bit later on this morning. Yields at 420 at the front end of the curve, 518 at the very long end of the curve. Had some real mixed data on the ISMs this week on both manufacturing and services, with the labour components of both of those surveys pointing in very different directions.
And we've seen that in some of the underlying data, and actually Nela Richardson just kind of underscoring how in the manufacturing side of things there's really been an absence of workers, and they've had to really pay up to hire people in the services sectors. That's where they have seen some people let go, and that's what you're seeing perhaps in the employment component that actually was in contraction for the ISM services. Prices paid, though, still climbing, and that speaks to the CPI print that we're going to get next week that potentially could be that much more important for exactly what the Fed does.
We've got a multi-speed economy, and you can see it in the earnings. See it in the earnings through the week. AI, Caterpillar crushing it, the haves, the airlines, the cruises, the theme parks doing fantastically well. The have-nots, I think, of McDonald's. McDonald's sales growth just a bit slower in America over the last year, and that's of concern.
Yeah, they did fire their U.S. Head of operations, so it isn't exactly just a question of the consumer. They did seem to indicate that there was an execution side of things here, too. Nonetheless, they have flagged that people have been really struggling at the lower end, and that they really have had to have value meals that can bring them in the door on a regular basis in order to get the profits that they're looking for.
Slowest growth in a year for U.S. restaurants over at McDonald's. The numbers out early this week. This morning, equities just about positive on the S&P, some weakness in tech. Let's get to the single names the morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing both SanDisk and Western Digital lower this morning, and it's really a case of high expectations catching up with them. Both beat on earnings, but the guidance for the first quarter did come in a bit light. And when you run up some 470% in SanDisk's case, and some 200% for Western Digital, the market really wants you to hit it out of the park, but they did not quite do that. And it's a similar story over at Datadog. Those shares are also lower, falling 18.5%. And this has been one of the rare bright spots in software, with the stock more than doubling this year, but this morning giving back some of those gains. The company beat on earnings, revenue, and even raised its full year outlook, but it appears investors were looking for even more given this reaction. So this theme catches up with Datadog, high bar for the high flyers. And we end on Keurig Dr. Pepper. Those earnings results just in, shares are up 1.25%. Like Coca-Cola, strong earnings there. It reported a better than expected quarter on both sales and earnings. It reaffirmed its full year outlook, and the big driver was its cold drinks business, more than helping to offset weakness in coffee. John.
Yahira, thank you. Appreciate the update. More from Yahira in the next hour. On our radar this morning, Google shaking up its AI leadership. A long-time Google employee central to the AI strategy leaving to launch a new startup. The head of Google DeepMind also moving into a chairman role at the lab. Elsewhere, new disclosures from Microsoft revealing the tech giant generates the vast majority of its AI sales from OpenAI. Roughly 70% of its total AI revenue for the year came from the firm, highlighting how dependent Microsoft is on its partner. And finally, investors bracing for the next potential hit to SpaceX. About $100 billion worth of stock is set to become available for trading today as a lockup for insider shares comes to an end. This is the first of several lockups set to expire in the months ahead.
This is actually incredibly important and potentially the source of some of the volatility going into this, the earnings report and after it. This concern that actually the price will go that much lower when actually there is more supply that comes into the market. It's important not just for SpaceX. It's important for Anthropic. It's important for OpenAI. It's important for all the other potential companies that could IPO in mega IPOs later this year or even next year. If you get a poor performance, how much does that clip the wings of some of the high flyers in the private market space? That, I think, is what a lot of bankers are going to be watching.
It's about 20% in this first stage. And some are saying that actually people might hold on to it because they want to see the price higher before they start to get rid of some of their shares, especially at a company that when they IPO'd, I believe the report from SpaceX was that more than 4,000 individuals were made millionaires at that company, people that have worked on the production line. They've held on to it this long, they might say, I need this price to be higher.
How quickly will they look to realise some of those gains? Brian Hamilton, the chair of the enterprise software firm LiveSwitch, warning the share unlock reinforces some of the same concerns raised at the IPO, writing retail investors are being asked to take significantly more valuation risk than employees and early investors who receive shares at much lower prices. Brian joins us now for more. Brian, it's good to see you again. When we spoke on the day of the IPO, I remember you called it an extraordinary company that's extraordinarily overvalued. Brian, do you still believe that's the case?
I think so. You know, what a world we live in. Look at the company. They cut their losses in half. They doubled their revenue, doubled their customers, and their stock price went down, as you guys know, by about 10% yesterday, only on Wall Street, you know what I mean? But look, here's the big picture. These guys are still priced at 50 times trailing sales of last year. So they're doing well on an operating level, Jonathan, but they're still overpriced.
Let's talk about what they are doing, Brian, at an operating level. There are several businesses in there. And Lisa was talking about this earlier this week. How do you value this company? I'm sure we had that conversation at the time it went public.
Yeah.
Is it a telecommunication company? Is it going to be a growing neocloud firm? How do you look at it?
Yes, it's all of that. It's Elon Musk's joyride. You know what I mean? I love the guy. What a great entrepreneur, but still overvalued. And unpacking what the company does, good luck with that. You know what I mean? But here's the thing, guys. Look at this. I will say I have to back off my thing from a couple of months ago. As you guys know, the price has been battered. I'm not surprised by that. But at an operating level, they're doing great. It's, you know, here's the thing. It's a good company that's overvalued. It's not complicated. It's a mishmash, as you mentioned, of a bunch of things that Elon wants to do. Great entrepreneur, but still super risky. Now, one last thing. I listened to your last segment. It is true that I thought it was about 7%, by the way, by my calculation. But there's a bunch of people who have been in the company, they're employees, and they're unlocking. But I don't think that's going to be a material thing. I could be wrong.
At the same time, there's a larger question here about whether this is a SpaceX problem or whether this is an endemic problem with a lot of big tech companies that have solid businesses that are doing great things, but are also promising to spend trillions of dollars in CapEx for plans that have not been realized yet in a very competitive environment. At what point do you see some of that as becoming increasingly a liability? I'm thinking of Meta. I'm thinking of others that are trying to expand their definitions.
I have always promised myself, I will always say, I don't know when I don't know. And I don't know. But so I go to the fundamentals of the company. The losses have been cut in half, and that's great. And there's a ton of investment, and none of us on this planet know whether this stuff is going to pay off. I started early, guys, in AI. This is ancient history, 25 years ago. But we don't know. You were right. All these companies are investing big time in AI. I think they've got to do it. Will it pay off? We don't know. So that's why we drift back to how is this company doing with customer acquisition, profits, and the basics?
At a certain point, there's also this war for talent. And we just saw it with Google yesterday. We clearly see it with SpaceX, with this belief that Elon Musk has a singularity and vision that can potentially propel the names higher and realize these dreams. I just wonder, do you think that some of the individual talent is being overvalued when you see things like these $100 million payouts for some of the AI specialists?
Yes. Yes. But again, this is an arms race, right? This happens in every great industry. Automobiles 100 years ago, you get all this growth, and what's happening, you're going to have fewer and fewer companies, and they're all fighting for talent. So these people are overpaid. There's no question. I'm one of them. You know, I was one of them. But that's the way it is. I mean, because, you know, that's the beautiful thing about tech, as you know, is it's intellectual property. So if they can get the best talent, there's a non-linear relationship with how that company will be valued.
Brian, if you ever want to be a co-host of this programme when someone's on vacation, maybe when I'm out, you should jump in. Let us know when you're in New York, please. Brian Hamilton there of LiveSwitch. Brian, thank you. Appreciate it. We've talked a lot this morning about the Federal Reserve, the lack of guidance, that the end of the spoon feeding for journalists who follow this institution, It's coming to an end, apparently. Maybe it's not. This came from the FT moments ago. Check this out. What a story from the Financial Times dropping this hour. Kevin Warsh is set to stick to his stripped-back communication style even after the Federal Reserve Chair's decision to offer scant details of his strategy on interest rates fueled a powerful sell-off in Treasury bonds. People close to Warsh said he acknowledged that he made mistakes in his first 10 weeks at the helm of the world's most important central bank, including failing to reinforce his key messages on price stability and sowing confusion over whether his longer-term plans to reform the Fed could affect near-term policy decisions. The story goes on. And then it gets to a very, very key line about what he may or may not do with policy in September.
Warsh would be prepared, according to the Financial Times, to raise interest rates at September's meeting if inflation readings released in coming weeks are hot and markets ratchet up their expectations for increases in borrowing costs. The people familiar with thinking said, now, is this a Nikki leak situation, but now to the Financial Times? And even with the Financial Times now dropping this story, it really makes me question why the Treasury Secretary decided to go after the Wall Street Journal reporter yesterday.
I'm struck by why we're seeing this story right now at a time when everyone seems to be speaking for the Fed chair, Kevin Warsh, but Kevin Warsh, and then saying that he is going to stick to the script, even if there were mistakes. I just want to get to the bottom of exactly how we put this in the panoply of potential options. Either way, what it does underscore is how much potential volatility is being baked into every single data point from here until the September meeting. Not necessarily the rhetoric that we get at Jackson Hole, because it's unclear whether we get any rhetoric. But what I do think will be interesting is CPI next week and then the follow-ons from there and how much that could really be determinative.
There's a worry about this bond market. Quite obviously, there is a worry and a concern about this bond market. The Fed chair contributed to that move on Wednesday with a clumsy news conference. His objectives are going to remain the same, and that's fine. But how he articulated those objectives became less clear. The preferred tool, I think, was one of the bigger issues in that news conference. If you are concerned about inflation, if you are willing to act, which tool would you use? Are you satisfied with just the market doing the work for you? Leaving that unanswered contributed to that move at the long end of the curve last week. You look at the defence that's come out from the Wall Street Journal op-ed. You look at the defence that's come directly from the Treasury Secretary, and now you're getting this, which essentially looks like, let's call it what it is. This looks like a leak to the Financial Times to tell you the thinking of the Federal Reserve, to show that he's still committed to raising interest rates if he needs to. Why do we need to do that a week and a day after the news conference last week? The only reason you need to do that is because the message you were trying to send in the news conference last week failed to land. You made a mistake. We acknowledged those mistakes in the article this morning, and that's okay. But for everyone who's come out since Wednesday to try and defend that performance of the Fed chair, this story in the FT completely upends all of that defence in the last week, because the story in the FT acknowledges that the people around the Fed chair were concerned enough about how this has played out in the last week that they felt like they needed to say something to the Financial Times.
And to me, the arguments people are making that it might actually force the Fed to act more quickly in order to get that confidence back seems to be increasingly on the table. And that is clearly what we are hearing in the rhetoric from Fed officials who otherwise might have even leaned into the disinflation story that some people still believe, Andrew Hollenhorst among them, will take place.
Every new central bank leader makes a mistake, and it's totally fine. It's not a big deal. Just got to acknowledge it was one. And I think we've come pretty close to doing that this morning.
And when you think about what's going to happen, as Lisa was pointing out, Jackson Hole, the end of this Financial Times piece says Warsh is expected to use his first speech at Jackson Hole this month to explain the intellectual framework behind his quiet revolution, including clarifying areas where he believes his own messaging has fallen short.
It's going to take some time to read that FT piece this morning for the market, but yields are starting to inflect higher at the front end of the curve. We're up by 3 to about 421. OK, I don't think it's a massive move, but an appreciation based on this article that you have got a Fed chair that's willing to use their main interest policy tool, their interest policy tool to address inflation if it remains where it is and gets hotter.
Right now, there's a 58% chance baked into the market that they will hike rates in September. Before the Fed meeting, it was 100% chance. And you saw the yield curve a lot flatter, the long end of the yield curve a lot lower. Question is, does this clarify anything? Because I'm kind of going in circles around what exactly is...
What are you confused about after reading it?
After reading it, honestly, He said that he's not going to reverse course, but he's going to try to clarify the messaging that he thinks wasn't given across at the previous meeting. So are you talking or you're not talking? Are you giving press conferences where you're going to say something or you're not giving press conferences? It just seems like talking without talking is not a very satisfying thing. It just feels like trying to obfuscate.
Claudia Sahm just tweeted the article and highlighted the part where the people familiar with his thinking said, and she says, Warsh is the Fed chair. We should all be familiar with his thinking.
Precisely.
We should not have to rely on anonymous sourcing.
It's OK that news conference didn't go well. I remember Chairman Powell having some atrocious news conferences. In fact, the guidance was so bad when inflation was so far above target. That's where the original leak to the Journal came from, following what we were looking at Michigan sentiment, and that led to a bigger hike and they had to leak it to the Journal. That was ridiculous. Give him a chance. Let's see what he says in Jackson Hole. I think it's good news that we're getting around to the idea that Wednesday was a mistake. In fact, I am far more optimistic and constructive on the future of the Fed under Kevin Warsh after we've acknowledged that Wednesday was a mistake. Trying to defend Wednesday and the communication effort in that news conference, that's where I was becoming more concerned and not less.
I agree with you. If this is coming from Kevin Warsh, again, why are we talking about it through anonymous reporting in the Financial Times if this is someone who really wants to be clear and focused in the communication that he does deliver?
But especially if that era was ending as well.
I mean,
apparently that era's not ending.
That's my question. I thought we were done with, Nikki leaks. Well, now we have FT leaks.
Journalists have their use, apparently.
Yes.
Apparently they do. We'll come back to this story later this morning. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Trump preparing fresh tariffs on imported polysilicon this time, the material used to make semiconductors and solar panels. It's a bid to boost U.S. production. The measures are part of Trump's effort to target an industry that China dominates. Analysts are anticipating a tariff of 25% to 35%. OpenAI is asking a federal judge to dismiss a lawsuit filed by Apple that accuses OpenAI of stealing trade secrets. Defense lawyers arguing that the suit falsely portrays the actions of the startup's employees. OpenAI's filing also alleges Apple's failure to integrate AI into its products. Meta saying that one of its AI models hacked into the systems of an outside service. The model exploited a vulnerability in a third-party service during cybersecurity training in a manner similar to previous instances with other companies, including OpenAI and Anthropic. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate the update. Up next on the programme, a family divided.
We don't have a current alarm bell sounding off in the longer run inflation expectations. I tend to lean a little more on let's be thoughtful about this. But why wait? Why wait is because we'll get more information.
Up next, we'll catch up with Al-Hussainy of Columbia Threadneedle, live from New York City. You're watching Bloomberg Surveillance. It's all happening this morning. Let's switch at the board straight away and get straight to the bond market. I want to look at 2s, 10s and 30s, and I want to talk about the backdrop for supply and why this Treasury Secretary increasingly sounds rattled. Alphabet kicking off a 10-part US dollar investment-grade bond sale. That headline dropping just moments ago. Yields are pushing higher at the long end of the curve. We're up 3 on 10s, up 3 on 30s at 520. At the front end of the curve, you're at about 421. We'll separate the two issues here. So we'll talk about supply and what it means further out along the curve. And then we'll talk about Fed policy in the front end of the curve in just a moment. But Bramo, more supply to contend and compete with what's coming out of the Treasury.
And the supply from the hyperscalers has been disproportionately at the longer end of the yield curve. I think something like more than 40% has been above 10 years in duration. So it just gives you a sense of why this is affecting the long end of the yield curve to the degree that it is.
And then this comes after this from the Financial Times. Hard to keep up this morning. This from the FT on the thinking of Kevin Warsh. Let's get to the quote. And the key piece of this, if you're following monetary policy, is that Warsh would be prepared to raise interest rates at September's meeting if inflation readings released in the coming weeks are hot and markets ratchet up their expectations for increases in borrowing costs. This according to the people familiar with the thinking of the Fed chair. With us around the table, Ed Al-Hussainy of Columbia Threadneedle. Ed, good morning.
Good morning.
OK, do you want to start with supply or start with the Fed? Where do you want to
go? Let's go
You get to
Fed.
choose. Start with
Let's
the
go
Fed.
with the Fed.
What's your reaction to that FT piece?
Look, I think the most generous interpretation here is we're doing a little bit of cleanup from the last press conference. There needed to be a course correction. The messaging was extraordinarily poor. And so this is a big first step in that direction. we still ultimately are left in a vacuum because we have not heard from the chair. And I think we'll wait until the end of the month to see if that changes.
Do you think the action in the long end of the yield curve has presented a real fundamental problem for not just the Fed chair, but also this Treasury Secretary and the bond market itself?
I think that's right. And you can see some hints of that in the yen intervention and the way that was structured, again, to preserve some of that foreign demand across the curve. I think the reality is when you take a step back, we've put a lot of premium into the long end of that curve. Some of it is inflation uncertainty. Some of it is supply related to the fiscal deficit. And then some of it is growth, because growth has surprised us to the upside as well. I think it's impossible to disentangle that cleanly, but the end result is there doesn't seem to be a break on that move higher at the moment.
So we're getting this Alphabet offering, and we'll get the actual tranche sizes. It's a 10-tranche bond sale. We'll understand exactly how much is being issued at the long end of the yield curve, and we'll get that to you as the data comes out. I am just curious, though, how much do you see the move up in the long end of the yield curve as being directly a consequence of the lack of reaction function that we're getting from Kevin Warsh and some of the credibility issues versus just the supply-demand dynamic and the elements that you're talking about?
Yeah, it definitely doesn't help, right? It's one factor. We ran that experiment around the FOMC press conference. We saw that premium going to the long end of the curve, which was quite unusual. We saw the curve steepen and the dollar and risk assets sell off, which was a way of markets telling us it's not just an inflation issue, it's an uncertainty issue that's being punted into the long end of the curve. Early days, right? Because we're just a couple of months in, but definitely off on the wrong foot.
What do you think the bigger threat to this bond market is right now? Because there are a range of threats. Supply from hyperscalers, Alphabet just dropping, uncertainty about the Fed, attempted cleanup through the Financial Times this morning, worries about the Japanese issue as well and the spillover risk. What's the dominant concern if there is one?
Gosh, it's so hard. It's sort of an all of the above issue. Look, I think ultimately it has to come down to the data. If the data continues to surprise to the upside, if we get more evidence that this economy is accelerating, both in terms of the growth outcomes, the labor market, and inflation. And those have been largely separate stories so far. If they start to converge, I think that combination could be quite toxic.
Feels like, Bramo, they are converging to some extent in the last hour or so.
I mean, right now, just looking and getting a couple more details about the maturity levels in some of these tranches of the Alphabet deal, including a 10-year, 20-year, 30-year, and 40-year issue. When you take a look at the schedule of debt, unclear exactly the total amounts that they're planning on any of these issuances. Nonetheless, it gives you a sense they are looking in every corner, under every couch cushion, to raise as much capital as they possibly can, potentially crowding out some others, like the U.S., average consumer or the average citizen to potentially borrow debt as well.
Can I sell you a 30-year this morning? Any interest at 520? When does that become a screaming buy?
Look, I think the outright level of yields, whether you're looking at the investment grade corporate bond market or the treasury market, the outright level of yields are quite attractive, particularly the inflation adjusted level of yields. But then you have to commit to hold that exposure, I think, for a protracted period of time and eat the volatility in the interim. And that's, I think, what some investors are finding to be quite dangerous at the moment.
Ed, it's good to see you. We appreciate it. Ed Al-Hussainy there of Columbia Threadneedle. What are 60 minutes for this bond market right now? Yields rising across the curve at the front end by 3, led by that story from the Financial Times this morning. At the longer end as well by 3 to 4 basis points. Pushed there by the headline drop in across the Bloomberg terminal just moments ago from Alphabet. Alphabet doing the Treasury no favours this morning.
I mean, again, 30 and 40-year debt. It just gives you a sense of how these companies are increasingly long duration as their promises and hopes and dreams have a long runway to play out.
The bond market in the driving seat this morning. Equity futures pulling back from session highs, up just 0.1% on the S&P 500. Up next, Peter Tchir of Academy Securities, the third hour of Bloomberg Surveillance, just around the corner.
The reality is this is an arms race.
We've come a long way very quickly.
It's healthy to see the market digest, the market to rotate a little bit.
We're still in an environment where you have earnings growth continuing to rise.
Is this an earnings bubble? The answer is no, it is not.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, The third hour of Bloomberg Surveillance starts right now, and your price action. The scores look like this. Equity futures pushing higher by just 0.1% on the S&P. Some tech problems out there for SanDisk and others. The Nasdaq is down by 0.6%. The bond market is the focus of attention this morning across the curve. Lots of little reasons, some bigger than others, for high yields on 2s, 10s and 30s by 2 to 3 basis points. 30s around 520, 2s around 421. We'll start with the longer end of the curve. Pushed higher, kicked around this morning by Alphabet kicking off a 10-part US dollar investment grade bond sale. The front end of the curve pushed higher by this story dropping from the FT, according to people familiar with the thinking of the Fed Chair Kevin Warsh, indicating that the Fed Chair would be prepared to raise interest rates at September's meeting if inflation readings released in the coming weeks are hot.
Who's this coming from? Is it coming from the Fed chair himself? Is it coming from people adjacent to his thinking? And why are we doing this if we just had a Treasury Secretary talking about how this is not the correct way to do monetary policy? Either way, it goes to the question of the market not understanding the reaction function of this Federal Reserve, understanding the individual reaction function by certain Fed members who have come out and spoken. Unclear if Kevin Warsh is in charge or if he is happy letting everybody speak for him.
And when it comes to this story, it also says that people close to Warsh said he acknowledged that he had made mistakes in his first 10 weeks at the helm of the world's most important central bank, including failing to reinforce his key message on price stability. Basically, lots of confusion when it comes to how the Fed chair thinks, why the Treasury Secretary is stepping in. And on top of all this, the Wall Street Journal front page is that he's actually having a discourse and taking several calls from the President of the United States.
Bring up the yield curve. Let's look at this together. This is not a big move this morning, but it's a continuation of a problem that's been building for quite a while. And you've noticed, and I'm sure you've all noticed, a bit of a trend emerging here. The amount of cleanups that we've had to do in the last week or so. There's a hit to Fed credibility. There's a cleanup through the Financial Times. The spillover risk from Japan is getting greater. It's increasing. The Treasury Secretary has to come out and do an attempted cleanup. The one thing that you can do very little about right now adds to the problems, and it's the competition for capital coming from the biggest companies on the planet that are also contributing to high yields. This is something that there is no circuit breaker for. The Treasury Secretary can do nothing about. The Fed Chair cannot address. This is a problem that's going to keep leading to high yields for this Treasury and for this Treasury Secretary.
Yeah, and even though it wasn't a huge move, you did see that shift higher in the long-term yield after we saw this issuance announced by Alphabet. We still haven't seen the total amounts of each tranche. Nonetheless, the fact that they're selling 40-year fixed debt and 30-year fixed debt and 20-year fixed debt and 10-year fixed debt raises the question of how many people want to buy duration, how many more of them want the extra income that comes from some of these big companies than, say, just purely taking the risk of the U.S. government, especially at a time where the monetary policy isn't as clear.
We heard it from TCW yesterday. It's going to keep coming. And it doesn't matter how much the rates are. These companies will keep raising capital to spend because they believe they're in an existential fight right now. Now, look, I understand there probably will be a number where they'll have to respond to it. But at the moment, based on what I'm hearing in fixed income and credit, we're not close to it.
That's why I read a couple of notes yesterday about the refunding announcement that we heard from the Treasury and how they said for now, or at least for the next few quarters, we're going to keep the funding the same. And the speculation was not that necessarily they were going to increase coupon issuance at the long end of the yield curve, but they might even decrease it at the long end of the yield curve in order to avoid competing with this. But what that does is it puts it more on the short-term debt market, which again puts Fed Chair Kevin Warsh that much more in the hot seat.
That's the great irony about Besson at the moment.
Yep.
The complaints about forward guidance, he's engaging in it himself at the Treasury.
And I'm pretty sure he sat around this table before he was anointed Treasury Secretary. He was basically in the running and really went after then Treasury Secretary Janet Yellen for issuing on the short end, which they are doing the exact same thing.
Peter Tchir of Academy with us around the table. Pete, I'm just going to bring you straight in to this conversation just to build on what we're seeing in fixed income right now. You've got pushback from the FT trying to clean up the performance last week in the news conference, noteworthy. You've got the Alphabet issuance, noteworthy. The risk coming out of Japan, more than noteworthy. The Treasury Secretary sounding rattled out on social media, somewhat noteworthy. How do you respond to all of that?
So one, I think we can add a couple other problems for the bond market is I think globally, everyone's having to issue debt, right? Every sovereign nation right now is having to pick up their issuance in terms of their defense spending. The Middle East, right, used to make a lot of money on oil. They'll probably make it again at some point. Again, they're now having to issue debt. UAE's had to tap into swap lines. So I think globally, there's this debt issuance. And one thing that made me extremely happy and probably not on anyone else's radar screen is Australia announced their first refinery in 60 years. So this concept of production for security, needing to produce your own things, it's not just a U.S. thing where we're growing it. I think it's occurring globally. So there's going to be more pressure on capital as we try and build out refiners, smelters, not just in the U.S., but across the globe. I think you're seeing things being pulled away from maybe the cheapest to produce place that are dangerous. You don't want everything in China. You don't want everything in the Middle East. So I think you're going to see long-term pressure on bond yields across things. Having said all that, I think it's fine for Warsh to be talking to the president. I actually think the president does not like to be felt in the dark, and he lashes out with random tweets at 2 a.m. So to the extent that he's involved, I think it gives Warsh a lot more runway, and I think it's a small price to pay for him to keep the president involved, let him know what's going on. And, maybe it's very different than what we're used to, but I think we haven't seen any really nasty tweets about Warsh, and I think that's part of it. This president does appreciate people who communicate with him and are available when he wants. For better or for worse, that's where we live in. I think it actually protects the market a little bit.
I don't really care if they speak or not. I'm interested in what they talk about, and whether the Fed chair responds to it. That seems like a very separate conversation, and the optics around it are problematic. Now, you think it's good. I understand why you think it's good, and that's important. You believe it's good because you don't want the Fed to take any more credibility hits. I might look at it differently and say the optics are suffering because of this at a time when the credibility is already being hit. And it makes it harder to repair through stories like the FT.
So I guess it all depends on whether he's communicating and taking direct advice and going to go ahead with it, or it's more keeping a potential issue at arm's length. And I kind of view it as probably keeping a potential issue at an arm's length by keeping him involved.
At this point, how much do you see where the long bond is as a constraining force on some of the not only valuations, but also ambitions of companies that might not have the balance sheets that, say, Google does?
So I think it will slowly add up to that problem. Right now, I do think, people are a little bit overhyped on, that we're going to get all this debt issuance, and I think people are prepared for that. So I think there's some room for spread compression actually in the coming weeks. Having said that, I'm really focused on the 10-year rate. I think it's the 10-year that's where you and I are most effective, right? If we go to look at our mortgage rate, that's where we're going to see it. So to me, the 10-year is the key. So long as that's 475, 480, maybe we're okay. That starts getting above 5%. I think it puts a big problem on the economy. Again, we're not seeing the home side of this market do well. That's what, this president really wanted, was get housing back, make affordability. It's not there. And to me, the 10-year is critical for that. And it's been heading the wrong direction. And I do think we probably get towards 5%, which puts further pressure on this economy.
We've been talking all morning about how much of some of the jitters that we've seen in the stock market have been fundamentally driven and how much has been technically driven. You've had a long history of studying leverage in markets. You've had a long history in studying market dysfunction in markets. How much are we seeing right now a structural problem of leverage and new exchanges that are creating volatility that has not yet been shaken out of the system to any degree?
I think that's a great question. I'm going to step back a little bit and go back to that April through June run, right, where the semis were screaming higher, right? Everyone wanted to say, it's because of this, it's because of that. Well, situational awareness was clearly playing a role, right? They were putting leverage bets in this market. They were buying. Guess what? That pushes those stocks higher. It feeds through, especially in the semis. There's a ton of leveraged ETFs, both on the stocks itself, but on individual companies. Those ETFs have to buy stock at the end of each day when it goes up. I think you had the momentum monkeys kind of come in. You had these people really chasing things. It drove it all these highs. And then all of a sudden, the unwind. So everyone wants to talk about the role that situational awareness had on this decline. They had just as much impact on the way higher. And I think one of the risks we're going to see is just like Archegos, a lot of the names that Archegos got involved with never saw those highs again, right? So I think we pushed these things very, very high. We're coming off. People are trading it. And I do think we probably had a short-term bounce. But I don't think the names that we saw move 10 to 15% last week, Amazon, Microsoft, they don't move 10 to 15% unless someone bought a huge portfolio and was trying to clean up that portfolio. So I think in the coming days and weeks, I'm watching very closely for, the NASDAQ 100 or in the semis to turn lower again. And I think we might be starting to see that. None of the issues have been resolved, right? The ability to create your data centers on time and at cost, still difficult. Not in my backyard is kind of getting worse rather than better. I think the president's trying to do some stuff about that, but it's not helping. And all of a sudden, cheap Chinese compute's everywhere, right? And finally, and this is the hardest part to figure out because I think no one's really talking about, But are people comfortable that they're getting the bang for the buck on what AI is delivering versus the current cost? I think that is waning a little bit. So I think the pressure on this market will resume. And the second it does, I think we see newer lows in some of these areas, and partly because there is so much leverage. These leveraged ETFs, to me, are incredibly dangerous.
Is there a level where it gets so low, though, that you think a lot of buyers come in?
I think we just had that. People kind of like this. They like the story. You saw those 10% moves, and everyone's like, oh, the AI trade's back on. Okay, and everyone seemed to have forgotten. So, again, I think people are caught net long again. There aren't many shorts in this market, so it doesn't take much to push this down. It's August, September, which aren't ideal times for the market. We've been propped up a little bit by the ongoing, reopening of the Strait. There's a lot of issues going on, so I think we can pull back a little bit further, and I think people did commit a lot of money in the last few days.
What do you make, though, of DeepSeek actually potentially raising their prices?
So, I try not to look at any one individual Chinese company. I think they are able to raise their prices because they are so much cheaper, so why not make a little bit more profit? That takes some of the pressure off the U.S. companies. But to me, we talked about this probably a year or so ago. Was DeepSeek a one-off, or is this more a sign that China's kind of allowing their entrepreneurship to grow? Now we have the Kin 3 model. I believe that there is this risk that China is kind of taking their millions of engineers, allowing them a lot more flexibility. And while they don't make high-quality chips, they make lots of chips. They do not have the same electricity issues that we necessarily have. And, I would not want to live in China where you have no personal freedoms. Having said that, if they want to build a data center somewhere and some town's not going to get electricity, whatever, that town's in trouble. So it's going to be very difficult to compete with them. And I'm really scared this looks like a BYD automobile, where BYD all of a sudden went from almost nowhere to dominating markets. I think we just saw today one of the Chinese semiconductor companies said to Apple they were actually going to raise prices because Huawei and the other Chinese cell phone companies are buying up so much. So I'm really worried that they're kind of able to repeat what they did in the early 2000s again with BYD and Huawei in this space, which I thought it was years off, and it looks like it's closer, and that's my fear.
Before you go, can we try again to say some 40-year hyperscaler debt? Any interest?
Yeah, I actually like it.
You like it?
I like it.
Tell us why you like it.
So I would not necessarily buy it on a spread basis. I think at this point you're getting paid to wait. And I don't know that we've hit a debt diet type moment, but I think everyone is now so geared up for, we're going to have spending. The tiniest hint that even one of them slows down spending, I think these things rip tighter. When you look at the bond market, if you're a bond market investor on a spread basis, it is the cheapest single sector. I had an interesting conversation with a hedge fund, and I think a lot of people are in the same boat. It's like, I would love to short this sector because every day it goes 5 wider, but I'd also love to be massively long because when it moves, it is going to rip tighter. So I think it's a dangerous game, but I would be buying that because I think on an all-in yield basis, you're getting paid attractively.
Yeah.
If there's a valuation issue, it's going to be the equity side, not the credit side.
There's something somewhat reflexive about this, though, because before they cut spending, you've got to get the pushback in the market, and you might get some wider spread.
And we had a little bit of that. But again, I think the spreads are so wide that these companies, they're phenomenal credits. It's the equity valuation that's going to bear the brunt of it. So I could see the equity valuation bearing the brunt. Again, when you go back to companies, 3 or 4 years ago, I believe, when GE credit spreads, and their stock was down, they started cutting back on it, and their stock went up. So I think we're nearing that stage for a couple of these companies.
You run the company for the equity holders, and at some point the bond market gives you a reminder, and Bramo, you have to change course.
Right. Yeah. I mean, that's essentially what happens. The problem is sort of like if everyone's waiting for the course to change and they're not pricing it in, then they don't have any incentive to do so.
Peter Tchir of Academy. Pete, it's good to see you. Thank you, sir. 10-part offering coming from Alphabet. The longest maturity, Lisa was talking about it, 40 years. CapEx of that company for this year, $205 billion at the high end of estimates. Their intentions, more than double the outlays of 2025. That's quite a jump. Negative free cash flow, you noted that after the earnings came out. You've got to borrow more from the debt market. The pressure's on, and yields are up.
And they're having a talent problem with one of their leads in DeepMind departing and starting their own startup. So they're going to have to pay up to get some new talent in there at the same time that they're trying to compete with this existential race.
Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Fed Chair Kevin Warsh will reportedly stick with his scaled-back communication style even after the Treasury market backlash. The Financial Times is reporting people close to Warsh saying he'd be willing to raise interest rates in September if inflation runs hot. Alphabet shares just down about 0.5% in the pre-market after the company announced a 10-part US dollar investment-grade bond sale. The latest test of investor appetite comes after the Google and YouTube parent company raised its 2026 spending forecast. President Donald Trump is denying reports that the U.S. is running low on munitions, posting on Truth Social that the country has massive amounts of weapons. Trump also warning people leaking statements about the shortages should face jail time. And that is your Bloomberg Brief. John.
Fonny, thank you. Thanks for the update. Up next on the programme, the morning calls plus Julie Drew of MoffettNathanson as SpaceX gears up to unlock about $100 billion worth of insider shares. Live from New York City this morning. Good morning.
Our sense is that the demand for AI is going to continue to grow, and therefore the investment cycle will continue. And what we heard over the last couple of weeks is the hyperscalers have at least one more year of higher CapEx. Extrapolating beyond that is where I think it gets really tough. You really have to make assumptions that are very hard to make right now.
That was Luria of D.A. Davidson weighing in on tech a little bit earlier. Equity futures on the S&P 500 just about unchanged. On the Nasdaq this morning, we're down by 0.75%. Await to this tape. Lots of reasons for it. In the bond market, lots of reasons for this too. 2s, 10s and 30s yields higher across the curve, up by 2 basis points on 2s, up by 3 on 10s and 3 on 30s. The pressure coming on the supply side, the pressure building on the Federal Reserve as well.
Yeah, and increasingly the question that we've been asking all morning is this presenting a real problem to the Treasury Department and to the Federal Reserve itself? Is this the kind of tightening of financial conditions that they want to see, or is this something that feels a little bit like it's become untethered from what the Fed says or does? And ultimately, that is an answer that we may get in the next couple of Fed meetings.
It feels like it's cleanup on Constitution Avenue and 20th Street this morning via the Financial Times with this line that Kevin Warsh would be prepared to hike interest rates in September after we've heard from everyone but Kevin Warsh about how he views the Federal Reserve right now and the economy. So this, to me, says potentially we're going to have a really big Jackson Hole speech where he has a lot of explaining to do.
We got a number on that supply as well coming from Alphabet. Check it out, $25 billion they're looking to raise in that bond sale. The supply keeps climbing.
Yeah, and it's one thing to have a $25 billion bond sale. It's another thing. 2 years ago, if we had said $25 billion of bonds being sold by one of the biggest tech companies, everyone would say, wow, that's a big sale. Right now, it seems kind of small relative to some of the other ones, and it comes after more than $200 billion of debt just raised by Alphabet itself. So it goes to the question of how much more is there and how sustainable is this? We just heard from Peter Tchir. He still likes it at these spreads, but in lieu of what? And how many people are saying we'd rather buy this than the U.S. Treasury?
And that's the price action in stocks and bonds. Let's get you some morning calls. First up, RBC raising its price target on SanDisk. Still the lowest on the street, saying long-term opportunities will offset near-term pressures. Your second call from UBS, cutting its price target on Western Digital, citing slower shipments compared to its competitors. And finally, Bernstein hiking its price target on SpaceX, expecting higher AI revenue and earnings. The three are calls this morning. Let's stick with SpaceX. Shares staging a modest rebound as investors brace for the unlocking of about $100 billion worth of insider shares. Julie Drew of MoffettNathanson with a neutral rating and 131 price target on the stock, writing, until we have more clarity on the big questions and until expectations reset to what SpaceX's technology can more realistic achieve, we remain on the sidelines. Julie joins us now for more. Julie, welcome to the programme. Can you just describe this staggered end to this lockup that we're about to witness over the next several months? How unusual that is for the names that you've covered in the past.
Sure. As you've mentioned, the first rung of the ladder of the lockup expiration starts today, and then you'll see incrementally more come to the float in the coming months up until mid of next year. But I'd say that we're not technical specialists, and we're less focused on the technical aspects of this trade and more about what happened to the fundamentals. And based on the earnings report we saw a couple of days ago, we're not sure that the expectations have reset fully for the fundamentals to see kind of raised estimates for an upswing.
How difficult is it, though, to understand the stock by purely looking at the fundamentals?
That's a great question, Lisa. The way to think about it is there are parts of the business, and we call it the known knowns and the known unknowns. These are the Starlink, broadband, kind of P times Q. You've got the AI terrestrial data centers, et cetera, and you can model those in the traditional way. And then there's a component of the value which we call our upside optionality, and that's to say, look, SpaceX owns the launch capability. If they own this bottleneck to this vast, potentially new expansionary TAMs in the future, there should be some value assigned to it. But all this to say, the way to think about how the stock moves from a fundamental basis is what happens to the modelable parts of the business? What are people expecting? And on our part, the Starlink mobile piece and the sustainability of the terrestrial IaaS pricing are questions that weren't completely answered on the call.
There's also a question of whether all of the spending will be worth it, Julie. And this is something that an increasing number of people are talking about. Does it make sense to try to compete with neoclouds and hyperscalers when you have really viable telecom businesses and space businesses that are actually yielding real profitability? From your analysis, how do you justify some of the expenditures that are exceeding expectations?
Sure. And what you'd see after Tuesday night's earnings is that investors were probably reacting to the step up, about $3.5 billion more CapEx than expected, largely driven from the AI portion of the business. The company noted under 1 year paybacks, but we'd say that the 30 to 50 million per megawatt that they're charging currently in their terrestrial is about twice to 3 times higher than most of the neoclouds would charge. And these are also deals where after a 6-month kind of minimum, there are 90 days where either side can back out. So there is definitely a question on the sustainability. And to your point about the other markets, the one thing to consider is that they promised, especially on the call, a significant portion coming in from direct-to-cell mobile. We'd say that from a physics perspective, it's unclear to us that that's going to be a business proposition that works. And on top of that, that's another business that's going to cost hundreds of billions of CapEx in terms of building out a terrestrial network. And the question then becomes, in your waterfall of prioritization, what are you going to spend on CapEx?
Don't they already have part of that business sorted out, though, with Starlink?
So there are two components. The Starlink broadband business is a meaningful business today. It's a totally different constellation of about 10,200 satellites versus the 650 in the mobile directly. What you heard on the call on the mobile piece is that in order to compete with the big 3 telcos, Starlink Mobile is thinking about putting out femtocells or small cell laser mesh network. In our view, that's going to be really difficult because if you think about just visually the small cells versus a larger tower today, it's just not comparable. And you've seen the big telcos spend about $650 billion in the decade prior to 2023 to build out what ostensibly was an already built out network. That isn't kind of a number to laugh at, and is something that SpaceX would have to consider in order to move forward, or get an NVMno agreement, which all big 3 telcos kind of vehemently denied on their earnings calls this past quarter.
Julie, appreciate the update from you. Julie Ju there of MoffettNathanson. That stock is up in the pre-market by 2%. Every conversation we have is about raising more capital and investing more into this economy.
It's endless, and that's both a source of strength and a source of potential vulnerability. Just unclear how the two really match up.
Up next, some breaking data, jobless claims just around the corner. Blerina Uruci of T. Rowe Price joins us for more. Jobs data about across, jobless claims. We're looking for a number around 200k. We're always looking for a number around 200k. The estimate in our survey this morning is 205. The previous read is 197. Phenomenally low. Just really, really low on a historical basis. Equity futures this morning on the S&P, positive by 0.1%. A bit of a weight to the tech tape this morning. On the Nasdaq, we're down by 0.6. In the bond market, heading into this data, yields pushing higher for several reasons, and we'll spend some time on that in just a moment. Up 3 basis points on 10s, up 2 on 2s. With your data, here's Mike McKee. Good morning, Mike.
Morning, John. You were looking for a number around 200,000. How does 199 sound to you? 199,000 initial jobless claims. That's not the all-time low. We saw that the low back to 1969 3 weeks ago, 188. But it is pretty darn low. Last week revised up to 198. So we're basically about unchanged on this whole thing. In terms of the continuing claims number, 1,801,000, that's an increase from 1,777 the 2 weeks before. Remember, that one is delayed. We also got some numbers on productivity. Non-farm productivity rose 1.4%. After rising 0.8% in the first quarter. That's a revised number. So productivity revised higher in the first quarter and significantly higher than anticipated in the second quarter. The anticipation was for a 0.6% rise. Initial unit labor costs come in at 1.3%, significantly lower than the 2.1% that was anticipated, although it was revised down to 1.3% for the first quarter. So at this point, it looks like there is a productivity story underway. Whether it has much to do with AI or not is something that economists are already arguing about.
Mike, we've got to spend some time. Forget the data. We've got to spend some time on this Federal Reserve piece in the Financial Times this morning. Claire Jones did a wonderful job of covering the ECB for many years in Frankfurt, now covering the Federal Reserve. What are your thoughts of this piece in the FT this morning on Kevin Warsh?
Well, my initial thought would be pretty much like everybody probably on Wall Street, that it's damage control by the Fed, an effort to kind of keep the markets from overreacting to the press conference that Warsh had and the criticism he's received since then. I think one of the things that's happened is that people on Wall Street have misunderstood a little bit of what Warsh is talking about. He wants to get rid of the forward guidance, such as we will keep this rate unchanged until we get to X date or X condition in the economy, versus if inflation continues to rise, we will have to consider what we're going to do, which is the reaction function. And those two things have gotten confused with people on Wall Street. On the other hand, Warsh has kind of missed the ball when he's talked about the market should keep its eye on the ball rather than the referee. The Fed's not the referee. The Fed is a player in the game, and no matter what he wants, you're always going to be anticipating what the Fed is going to do, because the Fed's reactions are going to change the yields that you're factoring into your models. So there's a little bit on both sides here. Maybe Warsh is trying to calm things down until he can explain more at Jackson Hole.
It's going to be quite a speech at Jackson Hole. Mike McKee, thank you, sir. Given what's in this piece about the speech in Jackson Hole.
Yeah, exactly. It talks about that at the bottom of the Financial Times piece. They talk about the fact that he's going to be working on this and talking about, let me get the exact wording of it, expected to use this speech to explain the intellectual framework behind his quiet revolution, including clarifying areas where he believes his own messaging has fallen short. The buildup now to Jackson Hole is huge. When some people were even questioning before the press conference he recently gave if he was even going to give a speech in Jackson Hole, it's now become that much more important.
Mission one was getting rid of forward guidance, and clearly he was so keen to do that. There was an unease drawing a distinction between that and providing a reaction function, and you could see that every time he was talking in the news conference. He was finding it really difficult to draw a distinction between the two. We're getting closer, at least, with this piece in the Financial Times. The fact this piece is in the FT tells you that it's something he does want to try and do.
Just to be very clear, I don't think it was Wall Street that was conflating reaction function and forward guidance. I think that Wall Street was saying, we understand with forward guidance we're not looking for it. Reaction function is what we're looking for. It seems to be more a matter of the Fed chair. This feels like couples counseling, where you need to sort of agree.
It's ridiculous.
But it does, where it's like you need to agree on a shared language before you can actually talk about the substance. And right now we're in the process of agreeing on the shared language with the Fed chair before we can talk about exactly what the substance is. Is the shared language going to be established early enough to potentially get to a place where credibility is regained?
Neil Dutta on Twitter, you either think Warsh is in charge of the FOMC or you think the FOMC is in charge of Warsh. It seems like he's struggling to get a hold of the committee right now.
It's been a rough start, and I hope in 12 months we're not talking about any of this.
I hope so too.
I really do, because the challenges in fixed income right now are so large, we don't need an extra one. We don't need this distraction. Alphabet this morning, just another example of that. The supply is going to keep coming. The competition for capital will keep rising, and we've already got problems with other policymakers elsewhere, right? We've seen that across Europe and in Japan. We don't need our own here in America.
Yeah, and this is the fear right now. How much has that added to the yield premium, the term premium on 30-year yields going to the highest level since 2008? How much has it been part of the communication, or is this just a structural shift that needs to be managed through a pretty difficult period?
Joining us now is Blerina Uruci of T. Rowe Price. She writes the labour market is stable but gradually cooling. Payroll growth no longer needs to be particularly strong to keep unemployment stable. Blerina joins us now for more. Blerina, welcome to the programme. I think we've got to start with the Fed before we get to the data. That FT piece really showing how he's thinking about things right now in a way that he didn't communicate in the news conference last week. What have you made of that news conference performance and the subsequent write-ups you've seen over the past week?
Yeah, so I think what Warsh has done very well so far has been to communicate the goal. He's been very clear about the importance of hitting the inflation target. I think what we have been struggling with, both as investors and Fed watchers, is figuring out how he intends to do that. So I think that's where we need more explanation. What are the tools? What is the reaction function? That's a spot-on comment from you guys. We don't need forward guidance. We're very good at reading the tea leaves. The market is, forecasters are. So I think any progress we can make in understanding how we're going to get inflation down to 2%, which everybody on the FOMC agrees is the goal here, the better off we're going to be and the less market volatility we're going to get from here. And I think also taking a step back a little bit from the Fed reaction function, I really feel the way the market pricing is set up right now and the discussion with the FOMC, the September, the October, December rate decisions, they don't belong to the FOMC. They're not going to be driven by market pricing. They'll be driven by CPI and PCE inflation data. It's as simple as that.
There is also a piece of the paragraph in here in this FT piece, Blerina, that I think is important too, and Lisa's talked about it repeatedly, the preferred tool. In the news conference last week, he was somewhat, and I don't know why, vague about what the preferred tool might be, whether it would be the interest rate, whether it would be the market, whether it would be the balance sheet. In this FT piece, it's pretty clear that they would be prepared to raise interest rates in September, and that's still the primary tool. Now, that might sound obvious, Blerina, but it didn't sound obvious last week in the news conference. Is that just a little bit of news?
I think, again, it goes towards clarifying how we're going to get inflation down to target. I think there was a narrative emerging in markets that the Fed can use the balance sheet, QT, reduce the size, reduce liquidity in the system, and that's going to tighten monetary policy, and they don't need to do as much on interest rates. I'm not on that camp. We know that QE works very well in times of stress. We're not sure how much tightening you need on the QT side in order to fight inflation and tighten monetary policy. So again, going back to what is the appropriate tool, I really think in times of high inflation, the Fed has one tool, and that's interest rates. So again, going back to the September pricing and September hikes, that depends on what's going to happen with the next two inflation prints. And here, again, I think the messaging that the FOMC doesn't focus on 1 month of data is very, very important. We need to look at the 3-month momentum, 6-month momentum of core inflation. We need to look at inflation expectations. What is this period of elevated oil prices doing to anchoring or de-anchoring those expectations? And that's what's going to drive the decision in the near term. And the policy tool to use for fighting inflation pressures right now, it's going to be interest rates.
How much does the labor market matter right now if it just sort of stays at this low hire, low fire dynamic, albeit with some steady underpinnings that seem to be, in pockets, accelerating?
I think right now the labor market is secondary to the inflation data. And I think that's what the payroll report tomorrow is going to show as well, that if we stay in this balanced situation of low hiring, low firing, the unemployment rate doesn't do much from here. What drives market pricing and the rates outlook is always going to be inflation. Now, things could change. The U.S. labor market can turn around quickly. On the downside, I think you would need big drops, big increases in the unemployment rate to shake the confidence that the FOMC has that the economy is doing just fine. And then to accelerate hikes, I think you would need a pickup in wage pressures or indication that the unemployment rate is falling below Nehru. I think those, combined with inflation being elevated for quite some time now, would add to the urgency to increase interest rates.
Do we have a sense, before the Fed conducts their review, of exactly which measures of inflation are the appropriate ones to use? Do we have a view of what could kind of cross the threshold of being too hot for CPI prints over the next couple of weeks? Or is it kind of a toss-up and just depends on how the members feel?
I can say how I'm communicating with our investment staff at T. Rowe Price and our portfolio managers. I think we basically need to see core CPI and core PC around 0.2 per month. I think this is the bare minimum in the coming months. At least this is how I'm interpreting the kind of guidance on the reaction function we've seen so far. And then within that, I think we need to see some progress on the services ex-shelter component that has been sticky. That relates very closely to domestic demand and the labor market. So the detail matters and the number matters. Now, if we see shocks one way or another from these components, and it's looking like one-off progress on inflation rather than the path for sustained move lower on core, I don't think that's going to be enough. So the number matters, and I think 3-month, 6-month annualized averaging around 2%, 2.2% is good progress, but how we get there is also important.
How much are you watching in terms of the progress developing in the Middle East? This potential that maybe the Strait of Hormuz will actually open if there is some sort of agreement between the Iranians and Omanis, and where do you think there needs to be a lid placed on energy prices?
I think for me, what's going to be very important is that we don't have risks of escalation and risk that energy prices and oil volatility will stay high. Because what we've seen since March is that oil prices and news from the Middle East have been really driving rates. And the reason for that is that oil has such a big impact on items that the consumer buys every day. It really risks de-anchoring inflation expectations. So rather than a level on oil itself, I think I'm more worried about continued volatility, because I think that will add to upward pressures on inflation expectations. And then if I had to pick a level, I think staying around $70 to $80 would be okay for reaching the inflation target over the medium run. I think that what we were seeing before March of this year, with oil around 60, looked unsustainable, and we don't need that in the U.S. economy to bring inflation down.
That's the range we're in right now. Blerina, it's good to see you. It always is. Blerina Uruci there of T. Rowe Price. Crude this morning, 80 on Brent. WTI around 76. A new risk event for the next 24 hours or so. Some debt coming from Alphabet, right? 10-part offering, $25 billion worth, the longest tenor. What was it, 40 years?
40 years.
Crazy.
So we'll see exactly what the reception is and how much people push back, and ultimately who gets punished. And this has been something that we've been talking about quite a bit. Who is the competitor with Alphabet to raise that money? Is it the likes of Meta and Microsoft? Is it the U.S. government? Or is it, say, some holdings in equities even, people who want some income? I mean, really, this is the key question. How does this ball of money continue rotating at a time where people are still talking about raising trillions and trillions of dollars?
The Treasury market, to some extent, paying the price. 30-year yields up by a couple of basis points, 10's up by 3, 464 on 10s, 30s still around 520. With an update on news worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Recapping the data we just got, initial jobless claims remaining below 200,000 for a third straight week, coming in below estimates at 199,000. Continuing claims did top survey estimates, coming in at 1.8 million. Alphabet looking to raise as much as $25 billion in that latest US IG bond sale. The Google and YouTube parent company offering notes in as many as 10 parts with maturities ranging from 2 to 40 years. Top leadership at FIFA standing behind embattled President Gianni Infantino, reaffirming their full support for him during a meeting in Morocco. Infantino's tenure was thrown into jeopardy as regional FIFA confederations began to turn against him, following his now abandoned plan to monetize the sport. And that is your Bloomberg Brief. John.
Vonnie, thank you. Up next on the programme, we'll set you up for the day and the week ahead. Plus, we'll catch up with Jonathan Krinsky of BTIG, saying the volatility in chip makers echoes the dot-com bubble. That conversation up next.
if you are in an environment where we are, as a society, raising trillions of dollars to fund this build out, if the Fed needs also trillions of dollars, they're competing with each other. And that kind of competition for capital means that you're probably going to see higher interest rates.
That competition continues. That was Jonathan Golub of Seaport. Not long after that, we got this headline, $25 billion bond sale, potentially. That much coming from Alphabet a little bit later. 10 parts, the biggest part, the longest tenor. 40 years. 40-year debt coming from Alphabet.
And this isn't an anomaly. We've seen as much as 100-year debt coming from some of the hyperscalers. Just to give some perspective on this, Alphabet so far this year has raised about $52 billion across U.S. and Canadian dollars, as well as sterling, euros, Swiss francs, and yen. All of that this year, adding to that another $25 billion potentially with this deal. And frankly, the sky's the limit for how much more they and everybody else will need to raise.
A monster equity capital raise in the mix as well in the last 6 months too. You went through all the different currencies. That's just an example of them trying to tap all the available pools of liquidity in all the different currencies they possibly can, because the competition for capital is that great. And they're not the only ones. Others will follow. We'll see more of these headlines in the next 12 months.
To the degree where it's changed the structure of a lot of banks, where suddenly they have a very different approach. It isn't just an equity underwriting exercise or a bond underwriting exercise. It is going around the world and presenting a capital raise strategy for all of your needs when you need to raise $2 trillion. So, I mean, it gives you a sense of how different this moment is than it has been in the past.
Closely tracking the demand, how well that will be received through the next few hours or so. Equity futures this morning up about 1/10 on the S&P, lower on the Nasdaq. The Nasdaq 100 down by 0.6. With some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We have a flurry of earnings to get through that we've gotten this morning, and we start with the software names. It is a rough morning for them, with Datadog, HubSpot, and Figma all selling off. The group had been staging a strong comeback as investors grew more optimistic that AI would create opportunities for them, not hurt them. But the reaction shows that the bar is still incredibly high, because both Datadog and Figma did post the beat and raises, while for HubSpot it was a bit of a different story since its outlook did come in softer than expected. Turning to the travel sector, with TripAdvisor, shares are falling more than 9% in the pre-market after missing expectations on both the top and bottom lines. And normally that would mean softer travel demand, but you can't say that when both Booking Holdings and Expedia came out with strong earnings this week, with Expedia saying that consumers are undeterred from higher prices when it comes to hotels and airlines. And we end on Peloton. Those shares also getting punished in the pre-market, down 11% after giving a weaker than expected outlook for the year ahead. And that's overshadowing what was otherwise a strong earnings report, with revenue topping estimates and the company posting its first full year of profitability. John.
Yahara, thank you. Thanks for this morning. Nasdaq futures then edging lower. Chip makers coming off another rocky session. Jonathan Krinsky of BTIG seeing more downside risk ahead, writing money has sloshed from momentum to value and now back to momentum. There are many participants still feeling the pain from July's unwind. They are likely to not want to feel that burn twice. Jonathan joins us now for more. Jonathan, good morning. A quote that jumped out from you this week for me was this one here. The S&P surging more than 5% over 4 trading days into a 52-week high. And you said in the last 30 years that has only happened 3 other times, including March 21, 2000, which was the dead highs of the dot-com bubble. Jonathan, just how aggressive and how rare has the price action been just over the last week in certain names and certain sectors?
Yeah. Hey, good morning. Well, I think that shows you, how rare the price action has been. To get that sort of move, 5% in 4 days in the S&P, we typically see that after a pretty good sell-off, and that's why you don't see it into 52-week highs very often. So, you could argue a sample size of 3 is statistically irrelevant, but I think that it just is another one of those trading signals that we've seen that continue to pop up that do rhyme with the late 90s and 2000 period.
Do you think that this is the beginning of the end of some of the leverage that's been used in purchasing these shares? Or do you think that ultimately we haven't really pushed out of the system and we're not going to for quite a while?
No, I think certainly that's part of the aspect of the fact that we probably don't see new highs in the high beta momentum area for quite some time. And, we looked back at 8 prior boom bust cycles, going back to the Dow Jones in 1929, the dot-com, housing in 05, et cetera. And typically what you find that first impulsive move down sees about a 35% drawdown over 26 trading days. That's exactly what we saw in high beta momentum so far. And then you see typically a subsequent 35% bounce. But of course, the law of averages, you need more like a 52% rally to reclaim those 35% losses. And so typically that initial rally, which we think we're in right now, does not get back to the highs because you don't have the same type of momentum and leverage. And I think what we saw last week with a high profile fund is just one example of that.
How immune is the equal weight, is everything else other than the tech sector to some of this volatility?
So, coming into June, we were actually proponents of the equal weight in some of the other areas of the market because we felt, that's where the money was going to move into. I think the issue now is we've seen a rally. If you look at the performance of the S&P sectors from the beginning of this quarter, right? So you had technology, discretionary comm services were the big hit to sectors, and then you had, I think, 5 sectors were up maybe 4% or more, and so you've had that unwind. The issue now is you've had a move into value sectors, you've had a rebound in Mag 7, and now the momentum and the semis have seen a little bit of a bounce, but they're kind of stalling out. And so I think the setup there leaves things vulnerable because let's say momentum does roll back over. We don't see another leg higher in the value sectors because they've already been rotated into. So I think that's the risk as we head into the back half of August.
John, it's good to see you. It always is. Thank you, sir. Enjoyed the research. Jonathan Krinsky there of BTIG, speaking from a very specific seat, speaking about the technicals. His view, though, I think is interesting because people are talking about this clearing event that took place after situational awareness, and I don't hear that listening to him and reading his research.
And I don't hear that talking to Pete Tchir, and I don't hear that talking to a lot of people who are talking about Bob Elliott, talking about how much leverage is still baked into the system in lots of ways, different than the financial crisis, but still not exactly a clearing event.
Do you think we've had a clearing event for this Fed, right? Washed out all the bad stuff
I hope so.
We can move on?
I think if they speak anymore, it's just going to be worse.
He's not even speaking, it's just everybody else.
Yeah, but everyone's speaking for him, which is worse.
OK, we'll see you tomorrow, and hopefully things have changed. Chris Verone of Bear Strategas, Priya Misra of JP Morgan, Nadia Lovell of UBS, Jeff Rosenberg of BlackRock. Payrolls just around the corner.